Hello everyone, I hope you guys are doing well and studies going in full swing. Today's video we would be covering arguably the most important and the tricky chapter of your CA final AFM, that is the chapter on foreign exchange. We would be covering all the concepts and close to 20 important questions, again covering all areas. So the source for this material is your AFM shield. In case you have it, you can refer that. Otherwise, even if you have studied from some other material, that is fine. All the concepts per se do remain the same. In terms of the questions, we will be covering it from the Super 90 file, which we have shared on Telegram earlier as well. So that 20 odd questions from the Super 90 file will be discussed. Okay, so let us get started. Before that, if possible, please do press the like button on the video and also subscribe and share it with your friends if you think that this content is helpful. Means a lot for us. Okay, so let us get started. When we look at foreign exchange, to start with, there is a bit of theory on what are the features of the foreign exchange market. Foreign exchange market is a market which is a 24-hour market, and there are a large number of buyers and sellers in this market. Can include importers, exporters, foreign exchange dealers, banks, speculators, etc. It is probably one of the very few markets that comes close to the definition of perfect competition, of having large numbers of buyers and sellers. Largely, it's an over-the-counter market, unlike equity, which is more of an exchange-traded market. This is more like a person going to a dealer and doing a transaction. It's more like an over-the-counter market. Now, important terminology over here would be something called as a direct quote. Direct quote is how many rupees per dollar. So, if you are in India, how many rupees, that is your home currency, for 1 unit of the foreign currency, so rupees 80 per dollar or rupees 90 per euro or rupees 100 per pound, are all direct quotes in India, because they give you how many rupees for a single unit of the foreign currency. Next, you look at indirect quote. When you look at indirect quote, that is the inverse of the direct quote. Like for example, if I do 1 divided by rupees 80 per dollar, it comes to $0.0125 per rupees. So how many units of the foreign currency per unit of the home currency will be said as to mean the indirect quote. Usually most of the problems are given in the form of direct quote and you can solve it directly. Some students prefer to look at the quote. If it is indirect, prefer to convert it into direct and then possibly solve. It is again not mandatory. You can solve in whatever method you are comfortable. The exchange rate notations, usually the notations are very logical. So rupees 50 per dollar obviously means for $1 you are going to get 50 rupees. The only challenge over here happens in case of certain problems, which is very important from an exam perspective, is if the rates are given in alphabets and in 3-digit format. So over here, if you are given something like USD INR, now on the face of it, it appears that this is dollar per rupees, but this is given as USD INR 72. Now actually the way it is more like a rupee per dollar rate. So then why is it given like this? Well, if you Google up as well USD INR, you will see the answer to be, let us say, 80. But if you Google up INR USD, actually INR and then USD, you will see the answer as, let's say, 0.0125. So as per market terminology, when you see the words USD INR, typically the rates have to be taken the other way around. So a USD INR rate of, for example, 72 would actually mean a rupees 72 per dollar rate. This is usually the case. In most of the problems, Institute has followed this convention. However, there have been two problems recently, one in an exam and one in the RTP, where you were given something like this INR USD and you were given 72. Now, this makes us kind of, at least from an exam perspective, a little more alert. We say that, well, when the rates are given something like this, rupees per dollar or something like this, there's no ambiguity. But when they are given in capitals, sometimes they apply this market convention, that is, they say USD INR is 72, sometimes they say INR USD is 72. So ideally there should be consistency, but till we reach a perfect world, at least from an institute exam perspective, what do you do? Well, generally you will have to remember the commonly traded currencies, like the dollar, the range is around 80. Euro, it is around 90-ish, pound, which is around 100-ish, and yen, then the yen is around 0.5, 0.4 per, let us say, yen. So there is 0.1 yen will give you, let's say, 0.5 or 0.6 or 0.3 rupees. So generally the rates will have to make sense. If they don't, like if you are given something like this, USD INR, we usually see USD INR will be rupees per dollar 72, the rate is fine. But when I see INR USD at 72, I don't say that this is dollar per rupees, this is actually rupees per dollar only. So we have given you certain commonly traded currencies along with the ranges. So preferably try to have that range in mind. I know you cannot remember everything, but institute does not ask you regarding everything. Most of the times the questions are around these currencies only. So if you have a broad idea, you should be able to tackle these questions and not lose your marks merely because you get the quotation incorrect. Okay, this is one problem area from an exam perspective. Another problem area, students always say how many decimals should you use for the purpose of currency codes. There's no set rule by the institute, but I personally prefer 4 decimals unless otherwise given for the exchange code. Most of the times, even if you look at foreign exchange dealers, they quote 4 codes, and then rupee or dollar values, we keep it up to 2 decimals. Okay, next you go to a concept, something called as base or non-base currency. As the name goes, if it is given rupees 70 per dollar, which is a currency which is in the denominator per dollar, that is dollar is in the base, that is called as a base currency, whereas rupees which is in the numerator is called as a non-base currency. Base is like the denominator. Again, this is a rough terminology, so you say every rate that is quoted is with respect of which currency, because there are 2 currencies in one quotation, rupees 70 per dollar. So per dollar, that means in the base there is a dollar, and hence the rates are quoted on a per dollar basis. So every evaluation that you do across the chapter, I prefer that you do it on the base currency approach. Usually in case of a direct quote, in the base you have the foreign currency. Okay, then you have apparently the easiest and actually one of the most difficult parts of this chapter, which is the bid and the ask. On the face of it, bid is the banker's buying rate of the base currency. Ask is the banker's selling rate again of the base currency. Usually banker will buy at the lower rate and banker will sell at the higher rate. So when you look at the rate of, let's say, 40 per dollar and 50 per dollar, you will say that if this is rupees per dollar basis, then banker will prefer to buy at 40 and the banker will prefer to sell at 50, in which case 10 rupees is the spread, that is a profit that the banker will possibly earn. Now this is bid and ask with respect to the dollar, because it is rupee per dollar, so it is with respect to the dollar. Now most of the questions that the institute gives are from the perspective of the customer, the client. So if I am an importer who has to pay $1,000, I will have to buy the dollars. If I am buying the dollars, the banker is selling the dollars and the banker sells the dollar at the ask rate. Whereas if I am an exporter, I have the dollars, I am going to sell it to the bank. If I am selling, the banker is buying, and hence the banker buys at the bid rate. Usually the framework that we use in determining which rate to be selected in a particular problem would be, please pay attention to this, you will first look at the rate. And again, this is generally foolproof. Okay, you will just look at the rate and figure out what is the base. Like for example, if the base is 0.0125 per rupee, let's say the rates are given something like this, 0.0125 per rupees, in which case the base is the rupee. Next, you figure out what you as a customer want to do. So what you as a customer want to do, or a client is want to do, let us say you are an importer who is supposed to pay $1,000, and as a result over here you want to buy the dollars. So you will say, what do you want to do, sir? We want to buy the dollars. However, are the rates quoted per dollar? No sir, the rates are quoted per rupee, and hence you have to rephrase this. You say that, okay, I would love to buy the dollars, so I will enter into a transaction with the bank whereby I can buy the dollars. But is the banker going to give me the dollars free of cost? No sir, I'll have to pay the banker something in return. So what am I going to pay? Well, I'm going to pay, that is give, that is I'm going to in a way sell the rupee. So what I will do is I will rephrase this and say that, okay, that means I will sell the rupee. Why? If the base currency is in the form of rupees, then my bid and ask will be decided based on what is going to happen with the rupee. So when the banker is quoting you 0.0125, the banker is saying that for every rupee, how much are you going to pay or how much are you going to receive? And hence we have to see that what as a customer you want to do in the form of the base currency, that is the rupee. Now if the customer wants to sell the rupee, what will the banker do? Well, the banker will over here buy the rupee, and banker buys the rupee at the rupee's bid rate. So when I look at the steps 1, 2 and 3, you don't need to show this to the examiner, but once you do enough practice, this comes subconsciously, automatically to you. And then you need to figure out how much is the amount to be paid or received. In this case, point number 4, you will use that, let us say $1,000. Remember, the dollar has to get cancelled, so if you multiply, it will become dollar squared, which is illogical, so you will divide it $0.0125 per rupee. So dollar and dollar will get cancelled. Your answer is in rupees, probably 80,000 rupees. So do I need to always do this? Well, it depends on the type of the question which is given. Like for example, over here, if let us say, just a second, if the rates that were given are, let us say, $0.0125 per rupees, and you are also given a rate of dollar, for example, 1 divided by 75, let us say. So over here, $0.0133 per rupees. Now these are the two rates which are there in front of you. So over here, for rupees, this is the bid rate. For rupees, this is the ask rate. But when I take the inverse, 1 divided by 0.0125, you will get around 1 divided by 0.0125, you will get around 80 rupees. This is rupees 80 per dollar. And when I do 1 divided by 0.0133, you will get around rupees 75. It's 75.18 or something, but let's say for simplicity around 75. In which case, what happens? Well, over here 75 is lower, 80 is greater. So this will become the bid rate and this will become the ask rate. This will generally be the rule that the inverse of the bid will give you the ask and the inverse of the ask will give you the bid. So over here, when I take the inverse of 75 rupees, it will come to 0.0133. Now, if the rates are given to you as rupees 75 per dollar and rupees 80 per dollar, you will look at the same evaluation. You will say, what is the base currency? Sir, my base currency is the dollar. Then as a customer, what do I want to do? Well, I'm an importer. I want to pay the dollars. That means I will buy the dollars. Now, because the base currency is in the dollar, I don't need to bother what is going to happen with the rupee. So if I am buying the dollar as a customer and the base currency is also the dollar, the banker is going to do what? So the banker is going to sell the dollar and the banker sells the dollar at the dollar ask rate. What is the dollar ask rate? So dollar ask rate between 75 and 80 is rupees 80 per dollar, and hence the deal happens at rupees 80. Now the thing is, what will you do? Well, $1,000 into rupees 80 per dollar, and that will give you the answer. Now a lot of times students are generally baffled with this bid and ask. They say that, sir, the inverse of the bid gives you the ask, which is agreed. However, inverse of the rupee bid will give you the dollar ask. So if I take the inverse of $0.0125, which is a rupee bid, I will get exactly 80, which is a dollar ask, and hence as long as you select the rates properly and then you arrange it in the formula, $1,000 into rupees 80 per dollar, so that dollar and dollar gets cancelled, or $1,000 into 1 divided by $0.0125 per rupees, dollar and dollar gets cancelled, your answers will always be correct. That is rupees 80,000. So you don't need to bother too much on these lines. In my opinion, if you remember these 4 steps. Step number 1, identify the base currency. Sir, what is the base currency? Denominator of the exchange rate code. Step number 2, figure out what you as a client want to do. You want to buy or you want to sell? Okay, you are an importer, you want to buy the dollars. However, that step 2 has to be in the context of what is there in the base of the exchange rate code. If you want to buy the dollars, that is the banker wants to sell the dollars, yes, but the base currency is not in dollars, it is in rupees. Okay, so if you are buying the dollars, that means in a way you are selling the rupees. If you are selling the rupees, that is statement in the form of base currency. You are selling the rupees and the banker buys the rupees, you will take the bid rate. Then whether to multiply or divide depends on the invoice value into, if the dollar gets cancelled, you multiply. If it does not get cancelled, you take the inverse and the dollar will get cancelled. We will do sums on this, which will give you a better understanding. I am going into a little bit of depth because at the end of it, I have seen so many students who know foreign exchange but miss out on selecting the rates. You can always convert everything into direct quote and solve, but in some questions like an arbitrage question, you will not even know what the direct quote or indirect quote is. So this is like the foolproof method. If you have done any other method and you are comfortable with that, you can even do that as long as you are comfortable selecting the bid and ask. So even if it takes time, invest that time and be very clear on the bid and ask selection. It will take some time, but once it is set in your mind, you will never go wrong over here. Another shortcut over here is the trial and error method. So what does the trial and error method says? That if you are baffled, you are unable to figure out which is your final answer, you do trial and error. There will be 2 rates. You apply both the rates in rough. Don't show it to the examiner. Apply both the rates in rough, and whichever rate gives you a higher cash outflow, will be selected, or whichever rate gives you a lower cash inflow will be selected. Remember, a customer will be always on the losing side of the exchange rate quotation, and hence if the customer has to pay between the two rates, he will always end up selecting or taking the rate which will result in a higher payment. Or if he has to receive money like an importer, then between the two rates he will get money which is the lower of the two, and hence that acts as a good cross checking base. I would not really look it as always a method to select. I will say that okay, if I am calculating and if I want to cross check, and I always say that between these two rates, okay, which of the rates gives me a higher cash outflow or a lower cash inflow will ideally be my final rate. No matter how much time it takes, be confident with your bid and ask selection, because a lot of students do make a mistake at that basic level. Next, you have something called as cross rates. Now, when do you go to the concept of cross rates? Well, let us say you are an Indian company and you want to trade in the Brazilian real. Now, the thing is, dealers in India don't keep the Brazilian real. Dealers in Brazil don't keep the Indian rupees. However, they keep commonly traded currencies like the dollar, the euro, etc. And hence, what we typically do is, if I want to find the rate of rupees to the Brazilian real, I will use an intermediate currency like, for example, the dollar. So, I'll say I will take the rupees per dollar rate and I'll arrange the quotes in such a way that the dollars get cancelled. So, into dollar per the Brazilian real rate. And hence, the intermediate's currency get cancelled and your answer is what you desire. Now the challenge over here is, what if cross rates come along with bid and ask, in which case you will first have to figure out which is the desired rate that you want. For example, you are an importer who has to pay Brazilian real, in which case your desired quote would be rupees per Brazilian real. Let us say in the denominator you want to pay the Brazilian real. So if the base currency is a Brazilian real, you want to buy the Brazilian real, which is in the same base currency, that is the banker will sell, and hence the rate will be the ask rate. Well, if this is the ask rate, then all the rates that you select, rupees per dollar or dollar per Brazilian real, will also be the ask rates. Now, this would work well if the question also gives you rates in a similar form. You want rupees per dollar, question also gives you, let's say 75 and 80 rupees per dollar. You want dollar per Brazilian real, question also gives you that. However, if it is not given in the same form, like you are given dollar per rupees, for example 0.0133 and 0.0125, for example you are given dollars per rupees, in which case you are going to be stuck over here. We will say that, well, you want the ask rate but with dollar as the base currency. This is dollar per rupee, rupee is the base currency, so you will have to take the inverse. So inverse of the bid will give you the ask. So when the rates are given in the same form as that in the question, so if your question has a rupee per dollar, you also want a rupee per dollar in your formula, you can take directly higher of the two as the bid rate, higher of the two as the ask rate, lower of the two as the bid rate. However, if your desired rate is rupees per dollar ask, the question has given you dollar per rupee, then the inverse of the bid will give you the ask. So we will do a practice on this to get a better understanding. So the first step is to get the desired quote, then formulate the equation in such a way that all the intermediate currencies get cancelled, like dollar will get cancelled, rupees will stay in the numerator, Brazilian real will stay in the denominator. When individual exchange rate quotes in the above formula match the quotes given in the question, so you want rupee per dollar, question also gives you rupee per dollar, then make no adjustment. Take the higher rate as the ask rate, lower rate as the bid rate. But if the desired quotes do not match, like you want rupee per dollar in the formula, but there is dollar per rupee in the question, then you have to take the inverse. But while doing the inverse of the bid will give you the ask. So you will take the other rate. So over here, we will do a sum on this. While doing so, we should remember that the inverse of the bid will give you the ask and vice versa. Again, there is LIBOR, which is an interbank offer rate, in case you have given, that is a base for the floating rates. Now, before you go to the purchasing power parity theories, one very typical question number 2, that the institute usually reviews, and we will discuss this largely for understanding the cross rate perspective, is question number 2. Various different formats of this question are there, but let us focus on the one in front of you. On 27th of December 2002, a customer in Bombay requested a bank to remit DG, that is probably a currency, 2,50,000 to Holland in payment for import of diamonds under an irrevocable LC. However, due to bank strikes, the bank could effect the remittance only on 3rd of January. That is probably 6 or 7 days later. The interbank rates are as follows. In Bombay, well, this is given as dollar per 100 rupees. we don't like such rates. We will convert everything into dollar per rupee. So if 100 rupees give me $3.15, then 1 rupee will give you how many dollars? You will divide it by 100. So basically, you will restate the rates. You will say this is dollar per rupee 0.0315 and dollar 0.0310. What you do over here on 27 December will also apply on 3rd of January. Then you have dollar per pound and DG per pound. So there are 3 rates given. The bank wishes to retain an exchange margin of 0.125%. How much does the customer stand to gain or lose due to the delay? So over here, what do you need to be remembering? You will first say that you want which rate. Well, you are an Indian customer, you want to remit, that is pay the DG. So you want, let us say, a rupees per DG rate. This is, let us say, a rupees per DG rate. However, is a question anywhere giving you a rupees per DG rate? No. And as a result, you will have to formulate the appropriate rate that you want. So let us say the way we have devised this, your base currency seems to be the DG. As a customer, what do you want to do? Well, you want to remit, that is pay the DG, and hence you want to buy the DG. Well, is that in the same base currency? Answer is yes, which means I don't need to restate anything else. That means what does a banker want to do? Well, the banker will want to sell the DG, and banker sells the DG at the DG ask rate. So over here, the appropriate rate should be the DG ask rate. Now, if you want the DG rupees to DG ask rate, there are 2 intermediate currencies over here, the dollar as well as the pound. So you will say that you want the rupees per dollar rate, again ask, into dollar has to get cancelled, so dollar comes in a numerator, per pound rate, again ask, into pound has to get cancelled, so pound upon DG rate, again ask, and as a result over here you will select the appropriate rates. Now the problem is, you want rupees per dollar. Is the question giving you rupees per dollar? No sir, the question is giving me dollar per 100 rupees. I say chalo, forget 100 rupees, let us make it dollar per rupees. So for 100 rupees, if I am getting $3.15, then for 1 rupee I will get 3.15 divided by 100, that is 0.0315 and 0.0310. Now the thing is, even under this, usually the bid rate is on the left hand side, the ask rate is on the right hand side, but that is not a rule. Like in Urdu, you write opposite. In Hindi or in English, you write, let us say, from left to right. In Urdu, you write right to left. For example, and hence bankers might give you rates in any format. In any way they are given, remember the lower rate will be the bid rate and the higher rate will be the ask rate. In which case, the bid rate per rupee is 0.0310, the ask rate per rupee is 0.0315, and hence we will restate these rates. Well, you will say, well, you know what, that means dollar per rupee. Well, just to restate, this will be 0.0310, that is the rupee bid, and 0.0315, that is a rupee ask. So this is your restated rate. So we will say that, okay, you want rupees per dollar ask, you don't have rupees per dollar ask, however you have dollar per rupee. Well, dollar per rupee, you will have to take inverse. So the inverse of the bid will give you the ask. So what is the selected rate? Sir, 0.0310. So this is dollar 0.0310. You will need some practice for this. Into, you want for the second rate dollar per pound. Well, you want dollar per pound, question also gives you dollar per pound, perfect. So if you want the ask rate will be the higher of the two, 1.7260. so this is rupees, or let us say dollar 1.7260. you want the ask rate, the rates are in the same form, you will directly take the higher rate. Now you want pound per DG. If you see the question, they give you DG per pound, and hence you will have to take the inverse. Now the inverse of the bid, that is 3.9575, will give you the ask. So into, okay, just a second, you will have to take the inverse. So the first rate also over here will be the inverse. In a similar way, inverse of DG 3.9575 to the pound will be taken, and if you do some working, you will get the answer at rupees 14.0688 or something per DG. We keep it up to 4 decimals. So this is the effective rupees that you will have to pay for 1 unit of DG. If you want, you can pause the video and try doing the working for January 3rd on your own. Hopefully you will select the rates properly, and in a similar form you will get 14.216 per DG. So these are the rates. So basically, if the remittance would have happened on December 27th, for every DG you must have paid rupees 14.06 0.0688 per DG. However, the remittance happened on Jan 3rd, where you actually ended up paying rupees 14.2146 for every DG, which means effectively, if this is for 2,50,000 DG, 14.2146 minus 14.0688, that is 0.1458 you pay extra per DG into 2,50,000, approximately rupees 36,450 you will pay extra. This would have been the end of the question had there been no exchange margin. Now the banker wishes to retain an exchange margin. Now the problem is, will the banker add? That's a transaction cost. Will the banker add or will the banker deduct? It depends on whether it is a cash outflow or an inflow for the customer. Remember, it is like brokerage. So when you go to buy a flat, when you pay brokerage, it increases the cost. 100 rupees ka flat plus 2 rupees brokerage becomes 102. But when you go to sell the flat, you will get 100 rupees minus 2, that is only 98. In a similar way, here you guys tell me, are you going to pay the rupees or are you going to receive? Is there going to be a cash outflow? You want to buy 2,50,000 DG so that you can remit it. So for that you will pay the rupees. If you are paying the rupees, it is like a cash outflow and the transaction cost increases the cash outflow. So over here, for your understanding, and there are multiple ways in which you can solve, you can say that your total cash outflow, all said and done, will be an additional burden over here. Add exchange margin of 0.125%. So we can directly even solve and get around 36,495.56. So you can either find the total cash outflow at 14.0688, total cash outflow at 14.246, add exchange margins over there and then find the difference, or you can directly take the difference in the rates, say that, well, you know what, the difference between the two is around 35,000, 36,000 and something, along with an exchange margin of 0.125% also that you will have to add, because this was a cash outflow and hence exchange margin will have to be added. So this is cross rate, something that you will have to practice to kind of get some comfort around cross rates with a lot of complications, like having a dollar per rupee. Then usually bid is on the left hand side, ask is on the right hand side, but here a lower rate is given on the right hand side, a higher rate is given on the other side. So playing up with all of these, try to do January 3rd on your own. Hopefully you get it right and you get that confidence that is needed, for example, for this cross rate working. So that is one particular thing on cross rates. Next, you go to the exchange rate parity principles. So over here, how are exchange rates determined? So we say that, for example, $1 is around 80 rupees, €1 is around 90 rupees, £1 is around 100. How are these rates actually determined? Well, they're determined based on the purchasing power. Like, for example, there's a basket of goods. For example, for simplicity, we take pens. Let us say in $1 you can buy 50 pens. However, with 50 rupees also you can buy 50 pens. So like you study in schools, if A is equal to B, if B is equal to C, then A is equal to C. Like if rupees 50 is equal to 50 pens, if those same 50 pens are equal to $1, that means what one green dollar can buy is exactly what 50 rupees can buy. And that is how you determine the exchange rates, based on the purchasing power of the currencies. Like you, for example, if you buy Starbucks coffee in India, it might cost you 300 rupees. If you go to the US to buy it, probably it might cost you $3 or $4. So when you look at that Starbucks coffee, for example, hypothetically, that same coffee is going to cost you the same once you convert it into the single currency. This is based on a lot of stringent assumptions like no transportation cost, no transaction cost, etc., no tariffs. However, on that simplistic base, we can say that a basket of goods in India or in the US will cost the same in their respective currencies if you use the same. So 50 rupees will buy 50 pens, $1 will also buy 50 pens. Sir, what if that does not happen? Then there is a possibility of an arbitrage. Like if for example, why should that be the rate? Well, if that is not the rate, then we can use arbitrage. Like for example, if the rate was something else, then I can buy pens in one country by paying 50 rupees, sell it in another country, get dollars and convert those same dollars into rupees. So let's say the rate was 60 rupees per dollar, then I will use 50 rupees per say in India, buy 50 pens, sell it in the US, get $1, convert that $1 into rupees and get 60 rupees in return, and hence an arbitrage profit of 10. So arbitrage will result in more and more people selling the dollars that they get by those pens, and hence demand supply will say that if more and more dollars are sold, the rate will go from 60 to let us say 50, and hence the rate has to stabilize at 50. Now why should the rates change? If the rates were actually based on purchasing power, The rate should change if the purchasing power changes. And when does the purchasing power change? Well, it changes due to inflation. Inflation eats up your purchasing power. Like for example, in India, the inflation was 10%, in which case those same 50 pence which were worth 50 rupees with a 10% inflation will now same 50 pence will be worth 55 rupees after 1 year. However, those pence at $1, if the US inflation was 2%, will be worth 1.02 after 1 year, and hence after 1 year we can say $1.02 will equal to 55 rupees. This is restated in form of a theory called as an inflation rate or an interest rate parity theory, which is 1 plus the inflation upon 1 plus the inflation of the other country. If this does not hold true, again there will be arbitrage which can be used, and hence this will actually hold true. Now the problem that students usually face is which rate to take in the numerator, which rate to take in the denominator. The working is very simple. If the rates are given to you, if the spot rate is given to you as 50 per dollar, that means 50 is in the numerator. So rupees inflation rate will come in the numerator, dollar is in the denominator, well the dollar inflation rate will come in the denominator. And as a result, if I want to find the rate, let us say 1 year later, I would say as per this formula, F is equal to S, that is rupees 50 per dollar into 1.10 upon 1.02, which means 50 into 1.1 upon 1.02, approximately it comes to around 53.92. Even if I do the rate over here, using this working, I would say 55 rupees divided by 1.02, 55 upon 1.02 comes to around 53.92. Sir, what if the rate is not 53.92? What if let us say the rate is 55, 58, 60, etc. Or let us say the rate remains unchanged. What if the rate is 50 rupees? In which case there is an arbitrage opportunity where I can use the 50 rupees, buy 50, or I can let us say use the 50 rupees, buy $1 over here. As you can see, start with 50 rupees, buy $1 with those 50 rupees, then use that $1 to buy 50 pence in the US, sell those 50 pence in India at 55 rupees because the price is 55, and end up with a profit of 5. So there's an arbitrage gain, and whenever there's an arbitrage, demand supply will ensure that the price will come back and stabilize at the rate of rupees 53.92. At 53.92 there will be no arbitrage gain or loss. Over here there will be a huge demand to buy dollars, and hence the rate will go up from 50 to 51 to 52 to 53.92. Now this is the 1 year forward rate. Is it necessary that the question might ask you to find a 1 year forward rate? No, it might ask you to find a 6-month forward rate, a 3-month forward rate. Now remember, throughout your syllabus you will assume annual compounding, which means if I want to find the rate after 2 years, yes, the working over here will be F by S into 1 plus inflation in the rupee. This is, let's say, rupee per dollar quote. So rupees in the numerator, dollar in the denominator, raised to 2 if it's a 2-year rate. However, if it is after 6 months, in which case under 6 months there is no compounding effect. Compounding happens only after 1 year, in which case your formula will be F by S equals 1 plus the inflation again in India into 6 by 12. There is no compounding effect upon 1 plus inflation, let us say in the dollar, again into 6 by 12. So this is an important tip, that if there is an exchange rate determination beyond 1 year, which is used a lot in international financial management chapter, then we do raised to 2, raised to 3, raised to 4 as the case may be. But if it is within a year, which is used a lot in the foreign exchange chapter, 3 months, 6 months, etc., then we use, let us say, directly into 6 by 12, 3 by 12 if you do it in months, or even if you do it in days. Now usually inflation rates and interest rates go hand in hand, and hence loosely speaking you can replace I of inflation over here with R of the rate of interest in India, as well as R as the rate of interest in the dollars as well. Now the actual derivation for that is based on the covered interest arbitrage principle that you will do, but till that happens, let us say you can use this as a very logical base for the purpose of your interest rate parity. Now what does this theory say? It says that if there are two countries, that is India with a 10% inflation and US with a 2% inflation, then the country with the higher inflation will always have a weaker currency. Like in India, you see that earlier the rate was 50, now it is 53.92. So every dollar will get 53.92 rupees. So for $1 you are getting more rupees. That means dollar is appreciating, rupee is depreciating. The general rule that you need to remember over here, so one is the rule of the numerator and the denominator. The interest rates in the numerator and denominator depend on the exchange rate. If you look at rupee per dollar quote, then non-base currency rupee will be in the numerator and the base currency will be in the denominator. Another important point that you need to remember is, due to application of IRP, countries with a higher inflation like India will have a weaker currency, and those with the lower inflation, let us say like the US, will have a stronger currency. Remember, your entire theory is taught from the perspective of inflation and interest rate. Practically they do play a role, but not the only role. Practically other things like balance of payment, current account deficit, fiscal deficit, demand supply, FDI, a lot of other things also play a role when you determine exchange rates, but you cannot put them in a formula, and as a result this is a formula that you will use for predicting the expected spot rate or the forward rate after 1 year. We believe that the rate should ideally be 53.92 if the inflation in India today is 10% and the US is, for example, 2%. Now some questions ask you to calculate something called as a forward discount or a forward premium. Now how do you calculate a forward discount or a premium? Well, like you do portfolio, you do P1 minus P0 upon P0 into 100. That will be the return of a share. Usually in portfolio the holding period is 1 year. However, if the holding period is not 1 year, you find what is called as the annualized return. In case of mutual funds, in a similar way, you do the working over here. We say that premium, forward premium or discount has to be calculated on a per annum basis. So for example, if the rate today is rupees 40 per dollar, that is called as a spot rate, and the rate after 1 year is likely to be 50 per dollar, or let's say rate after 6 months is likely to be 50 per dollar. So this is P1, that is 50 per dollar, minus P0, that is rupees 40 per dollar, upon P0, that is rupees 40 per dollar. P1 minus P0 upon P0, or F minus S upon S into 100. This will give you the forward premium or discount, as a case may be, for the base currency. However, this is for 6 months. The rate is moving from 40 to 50 in a span of 6 months only. So on a per annum basis into 12 by n. So this is on a per annum basis into 100 into 12 by n, or m, which is a number of months, and that will give you a forward premium if it is positive, forward discount if it is negative. So forward premium or discount on the base currency will be usually P1 minus P0 upon P0, or F minus S upon S into 100 into 12 by m. However, a shortcut for the non-base currency would be, I will take S minus F. So if there's a premium F minus S, I would say S minus F, that is 40 minus 50. So discount becomes negative, upon, you will divide by F into 100 into 12 by M. Sir, why? Well, if there's a premium in one currency, there will be a discount in the other currency. Or if there's a discount in one currency, there will be a premium in the other currency. Second, when you move, let us say from 100 to 120, that's an increase of 20%. But when you move from 120 down to 100, that's not a fall of 20%. It's only a fall of 16.67%. 20 upon 120 is 16.67%, and hence because of a different base being used, your percentage changes. Like in your foundation, you would say a percentage of cost price or percentage of selling price. Similar is the working over here. So we said that, okay, earlier we took the percentage based on 40. Now for the other currency, you will take the percentage based on the other, and hence that is 50. So over here, these are the two formulae that you will use. This S minus F upon F is the formula for non-base currency. So if it is a rupee to dollar quote, that means for the dollar, this will be the forward premium or discount, and for the rupee, this will be the forward premium or discount. Okay, considering that, to apply this, we will try one more problem on these lines. So if you go to question number 1 over here, let us say we go to question number 1. Question number 1. Over here, we can do one of the time periods together, and the other time periods you can actually try on your own to get a better understanding. The following table shows the interest rates of US dollar and the French francs. The spot rate is 7.05 franc per dollar. So this is your S. Franc is in the numerator, dollar is in the denominator. Complete the missing entries. For 3 months, you have the dollar rate, the franc rate. You want to find the franc per dollar. So this is using IRP. F divided by FF, 7.05 to the dollar equals, in the numerator what will we have? Well, the rate is FF per dollar, and hence FF is in the numerator 1 plus 0.195 into 3 by 12 divided by 1 plus 0.115 again into 3 by 12. If I go ahead and do this working, you will come to an answer of FF 7.1871. This is to the dollar. So this will be your forward rate. Now we want to find the forward discount per franc. You guys think and tell me, what should the formula be used? It is per franc. Now franc is the non-base currency. Remember, the F minus S upon S formula is the standard formula used for what is there in the base, that is a dollar. However, you are trying to find the discount or premium for the franc, and hence the formula that will be used over here is S minus F upon F into 100 into 12 by M, which is 3 months, which is over here, if I do it directly, 7.05 minus 7.1871 upon 7.1871 into 100 into 12 by 3, and that will give you 7.63% negative. Negative means a discount on the franc. You will do a similar working for 6 months and then for 12 months as well. So when you look at 6 months, you have been given the dollar rate, not the franc rate, not the franc, and you have been given minus 6.3% as the premium. So if I were to do this working, I would say that, well, you know what, minus 6.3 will equal to S minus F, that is 7.05 minus F upon F into 100 into 12 by 6. If I take 100 on the other side, this is 0.063 into 6 divided by 12 equals 7.05 minus F upon F. And if you do this working, ultimately your F will come to approximately 7.27. Use that in your IRP, taking your interest rate as missing, and you will get 19.14%. You can pause and try separately for the 12 months on your own as well. There is nothing new over here. If you can understand the IRP formula as well as the forward interest, forward discount or premium formula. Perfect. So that kind of takes care of the first part. Next, you have something called as forward hedging. One of the most easiest products that are used for the purpose of hedging in case of foreign exchange is forward. What do you mean by a forward? Let's say if I am an importer who has to pay $1,000 after 6 months, I am worried that the rates would change. So I will go to the bank and I will fix up the rate today. That is, I will say that for me having to buy $1,000 from the bank after 6 months, what is a predetermined rate? Let's say the banker quotes me 82 per dollar, which means 6 months later, whether the rate is 85, whether the rate is 75, I will buy the dollars from the bank by paying 82 rupees. Now this results in what is called as hedging. Hedging refers to risk reduction, risk minimization, and that results in reduction of uncertainty. So that is going to give you a constant cash flow. Now some questions in case of forward ask you to calculate the gain or loss if the transaction remains unhedged. How will you find the gain or loss if the transaction remains unhedged, or what is the expected loss? Like for example, today on 1st of January, when you actually do the import, the rate is rupees 75 per dollar. Let's say on 30th June, 6 months later, the spot rate actually turns up to be rupees 85 per dollar, which means had you kept the transaction unhedged, for $1,000 which you thought would be at 75, you actually ended up paying 85, and hence rupees 10 per dollar into $1,000, and 10,000 will be your expected loss if the transaction remains unhedged. However, if I were to do hedging, if I were to hedge using a forward contract, spot rate still is 75. However, I have hedged at taking the forward rate at rupees 82, which means the loss under hedging would be, well, today the rate is 75, the bank is not giving you the dollars at 75, it is giving you at 82, that is 7 rupees per dollar into $1,000, that is 7,000. However, if you had kept it unhedged, the loss would have been 10,000. So hedging helps you reduce the loss by 3,000. So if the question asks you to calculate expected loss if the transaction remains unhedged, you do it at this 10 rupees per dollar. The question says also find the gain or loss due to hedging, that is 7 rupees per dollar, and show how the gain or loss can be reduced due to hedging. Then that is 10 minus 7, that is equal to 3. Now some questions don't ask you this long scheme of things. They directly ask you that what is the advantages of hedging. We will say that even if the transaction remains unhedged, I would have paid 85. Due to hedging, I am paying, let us say, 82, and hence the advantages of hedging or gain due to hedging is 3 rupees per dollar. So over here, if I look at the gain or loss if the transaction is hedged, effectively it is at 3, which can be calculated by comparing 10 rupees of loss under unhedged with 7 rupees of loss under hedging, that is 3 rupees of gain, or it can directly be compared by 85 with 82 to give you the 3 rupees of gain due to hedging. Okay, in forward questions, a lot of times the institute does not give you the forward rate directly, instead it gives you something like points. Now what does it mean? For example, you have been given a spot rate of rupees 82.1535 per dollar and then rupees 83.1355 per dollar. Okay, this is your spot rate given, and then you have been given 1 month forward. Ideally, if the rate is given, nothing like rate. However, you have been given 125 and 145. Now, what is this? Swap points help you calculate the forward rate from the spot rate. How do you adjust the swap points? There are a few rules that you have to remember. If the swap points are given in ascending order, A for ascending, A for add. So over here, this is 125 and 145, that is given in ascending order, so you will add. However, the swap points are given in descending order, D for descending, D for deduct. Okay, so over here we would say that okay, this is 82.1535 plus 125. Now these are points, they will be always based on selecting the decimals from the right hand side. So if your quote has 4 decimals, this 125 will be read as 0.0125. Similarly, the quote over here has 4 decimals, so this 145 will be read as 0.0145. The bid points to the bid quote, ask points to the ask quote. However, if you were given this 145 and 125, in which case this is given in descending order, D for descending, D for deduct, and as a result I will deduct 0.0145 from the bid and deduct 0.0125 from the ask. This is because usually the longer the maturity, higher the spread, higher is the risk for the banker, and hence banker wants a higher spread for every longer maturity. Usually ascending points will increase the spread if you add them, descending points will also increase the spread if you deduct them. So this is a little difficult to comprehend at this stage. Even if you don't kind of understand the rationale, just remember always, if points are given in ascending order, you will add. If they are given in descending order, you will deduct. Bid points to the bid rate, ask points to the ask rate. The points will be in decimals, but the decimal depends on the rates which are given in the question. If the rates have 4 decimals, then this will be quoted accordingly. Sometimes these points are given in percentage. If they are given in percentage, then you will directly adjust the percent. So if it is given as 0.12%, then 82.1535 plus 0.125%, you will directly take the percentage then. So these are, let us say, the rules for swap points: ascending order add, descending order deduct, bid points to the bid rate, ask points to the ask rate need to be adjusted to the number of points on the right hand side. Okay, then you have a concept of something called as a covered rate or square off rate. What do you mean by covering? If you are a trader who has bought the dollars, however, now you want to close your position. You say, okay, I bought the dollars, now enough is enough, it has become very volatile, I want to exit my position. What will you do? Well, we will take the opposite position, that is, you will sell the dollars. So the rate at which you sell the dollars is called as a cover rate, or also called as a square off rates. So for this, if you do a couple of problems over here to apply these principles and get better clarity, let us say you go to question number 5. We will do all the questions, but in a particular sequence. You go to question number 5. You, a foreign exchange dealer of your bank, are informed that your bank has sold a TT, that is a telegraphic transfer, that is a currency, on Copenhagen for Danish kroner 10 lakhs. Copenhagen is the capital of Denmark. For Danish kroner 10 lakhs. So you as a dealer, your original position is what? Well, you have entered into a sale of DKK 10 lakhs at the rate you have been given rupees 6.515 per DKK. Okay, this is your selling price. You are required to cover the transaction. Achha, how will you cover? You guys tell me. If you have entered into a transaction which is a sale transaction, you will cover it by buying. Cover the transaction either London or New York. The rates are as follows. You are given Mumbai to London, that must be rupees to the pound rate. Mumbai to New York, that must be rupees to the dollar rate. And then, so this is rupees, which means this must be dollar. And then London, Copenhagen, New York, Copenhagen. So this must be, let us say, DKK as given over here per London, that is pounds. This is DKK, let us say, per dollar. In which market will you cover the transaction, London or New York, and what will be the exchange profit or loss on the transaction, ignoring brokerage? Now the thing over here is, you will buy how much? Well, you will buy again DKK 10 lakhs. In which market? Well, you have to buy the market which is cheaper. Remember, you may be a foreign exchange dealer, however, now If you want to cover, you will have to go to other dealers, which means you are like every other customer for them, and hence you will buy DKK at what rate? Sir, you will buy DKK at rupees per DKK. Which rate? Sir, rupees per DKK. You want to buy, think of it this way, you want to buy the DKK, that means the dealer in the interbank market will want to sell the DKK. Sir, why do you want to buy? Well, originally you have sold, you want to cover the transaction, so you want to buy. So you will buy rupees per DKK. Acha, what is the base currency? DKK. You want to buy, base currency is the DKK, you want to buy the DKK, which means the banker will sell the DKK, and hence the transaction happens at the ask rate. But there are two markets, one is rupees per pound, where pound is the intermediate currency, and pound per DKK. So there is a market where pound is the intermediate currency. There is a market where dollar is the intermediate currency. So you have rupees per pound. Again, you have two rates, bid rate and the ask rate. Rupees per pound. Well, you want rupees per pound ask. Question also gives you rupees per pound, which means higher of the two, 74.32. You don't have to change the rate, so 74.32 to the pound. You want pound per DKK, but the question gives you DKK per pound, and hence you will have to take the inverse, but the inverse of the ask will give you the bid, and hence 1 divided by DKK, 11.42 per pound will give you your answer. So 74.32 divided by 11.42 will come to 6.5079. So this is rupees 6.5079 per DKK. You will do the exact same working for rupees per dollar. If you want to pause, you can pause and try. I still want to arrange DKK, but now my intermediate currency is a dollar. So I'll arrange the quotes in such a way that the dollar gets cancelled into dollar per DKK. Now the problem is you still need to buy the DKK even if you go through the London market or New York market. So if you are buying, the banker is selling, and hence the required rate is the ask rate, and hence both of these are asked. So you want rupees per dollar. Question also gives you rupees per dollar, which is 49.2625. 49.2625. No changes. You want dollar per DKK. Question gives you DKK per dollar. So the inverse of the bid, that is 7.567, will give you the ask, and as a result 49.2625 divided by 7.567 comes to around rupees 6.5102 per DKK. Now given a choice, if you have to buy, you will buy in the market which is cheaper, which is the London market, and hence your gain or loss on covering would be selling price, that is 6.5150 per DKK. This is given to us, selling price, minus cost price in London 6.5079 per DKK. This is per DKK, and into you have around 10 lakh DKKs, and hence the difference over here will give you the gain or loss in DKK as the case may be. So this is your question number 5. Okay, another question that you want to try over here, which largely pertains to your market convention being applied as well as your swap points, is question number, I think you will go a little behind, question number 15. So it's a little problematic, this question, where you will apply the swap points, you will also apply the market convention and get your answers. You have the following quotes from Bank A as well as Bank B. Please pay attention over here. Very high probability you make a mistake over here. Spot rates are given USD CHF, USD CHF, GBP USD, GBP USD. Now the problem is, this is when the rates are given in capitals, you will have to apply market convention unless given otherwise. So unless the rates are logically there, you will apply market convention. And does it, what is CHF? The Swiss franc. You don't know much about the Swiss franc, but you know between the pound and the USD, what is more stronger? Sir, the pound is more stronger, and hence for 1 pound you will get more of USD. So the rates over here which are given is GBP USD appears to be what? Dollar per pound. The rates which are given as USD CHF as a part of the same question should ideally be what? Sir, CHF per dollar. In one question, if market convention is applicable, what does market convention means? USD INR is actually rupees per dollar. In a similar way, GBP USD is actually dollar per pound, though literally it appears to be pound per dollar. So this is something which is there in the institute material, which you have to be a little careful. Calculate how much minimum CHF you have to pay for 1 million GBP spot. So what do you want to do? You want to buy the GBP and sell let us say the CHF. So you want to find the minimum amount. So over here you can arrange the rate as CHF to the pound rate or pound to the CHF, whichever you're comfortable. Let us say we say CHF to the pound. So what is your base currency? Sir, my base currency is the pound. In the rate, I can even take a pound per CHF, in which is the base currency will be CHF. Now what you as a customer wants to do? Well, you want to buy the pound, which means what will the banker do? So the banker over here will sell the pound, and hence the answer is CHF per pound ask rate. Now the problem is in the question, you don't see the CHF per pound ask rate, you see the CHF per dollar. And dollar is an intermediate currency, dollar per pound, which means the dollar and dollar will get cancelled. Your answer will be CHF per pound. So you will select the appropriate rate. Now you want to find the minimum CHF you have to pay for 1 million GBP spot. Minimum CHF, which means the lowest possible CHF. Now students would generally say that I will either find the rate that bank A is quoting, do the cross rate for bank A, then do the cross rate for bank B, and then compare. Is that correct? The answer is no. Remember, for you don't necessarily have to buy both from bank A only. You can buy one of the currencies, let's say dollars, by paying CHF from bank A, and then using those dollars to buy pounds, let us say from other bank, bank B, wherever it is cheapest. So this is something that you have to be a little careful. Now you want CHF per dollar ask. So for you today, CHF per dollar ask is a higher rate, 1.4655 and 1.4660. For every dollar you will like to pay as least CHF as possible, and hence you will select 1.4655. You will say CHF 1.4655 per dollar. This is from bank A. So now you have dollars with you. For every pound you will like to pay, this is dollar per pound if I am not wrong, yes, dollar per pound. Over here we will say that for every pound how many dollars do you have to pay? 1.4660 and 1.4650. Given a choice, you will prefer to pay the lower value, that is from bank B. See, remember, you are not taking the bid rate. In both places you are very well taking the ask rate, so your relevant numbers are these numbers. So you are taking the ask rate, but the lowest possible ask rate wherever you are getting is what you would want. So for converting dollars to pounds, you will pay lesser dollars in bank B. So this is 1.7650. So this is, you want $1.7650 per pound, and hence if you multiply this 1.4655 into 1.7650 comes to around CHF 2.5866 per pound, and for 1 million pound you will multiply and you will say around CHF 25 lakh 86,660. This is the bare minimum CHF that you will pay. Any other rate combination and you will be paying more CHF. Second, consider the codes from bank A only. Now they are clearly telling you to take only bank A, which means for the second part bank B will be ignored. For GBP CHF, GBP CHF is what? Again CHF per pound. What are the implied swap points for spot over 3 months? Now how is swap points calculated? Usually you add the swap points or deduct the swap points to get the forward rate. However, here the points have already been given, but these are for CHF to dollar and dollar per pound. So what will you have to do? Well, for 3 months, so 6 months is irrelevant. For 3 months, you will find the relevant rate for bank A. Well, for CHF per dollar, ascending, and hence you will add. So this is 1.4655 and 1.4655 plus 10, 65. Okay, this is your rate. Second, for dollar to pound, 2520. So this is descending order. So you will deduct 1.7645 minus 0.0025. 4 decimals. So this is 1.7260, and in the second case 1.7660 minus 0.0020. This is 1.7645 40. Now what do you do? Well, you want to find the swap points, in which case you will need the spot rate that bank is quoting, and you will also need the 3-month forward rate. Okay, the rate can be found as CHF per pound equals CHF per dollar into dollar per pound. You want CHF per dollar, question is also given you CHF per dollar. You want dollar per pound, question is also given you dollar per pound. So if I look at the bid, this will be 1.4655 into, so you have taken this rate, into 1.7260. This is for the forward, sorry, 1.7260. For the ask, 1.4665 into 1.7640. So you will get these forward rates. 1.4655 into 1.7260 comes to 2.5295, and 1.4655 into 1.764 comes to 2.5851. Similarly, you will do the working for the spot. For spot, you will multiply 1.4650 with 1.7645. So over here, as you do the working, you will find the 3-month forward rate like we found over here, if I am not wrong. If we just verify this, 2.5295, 2.5851. So you look at the forward rates, 2.5822 and 2.58. Just a second. 1.72, 1.7620. I think we have written this. There is some. So this is 1.76. It's a typo, not 1.72. 1.7620. 1.7620. So if you do 1.4655 into 1.7620, 2.5822, 2.5822, and 1.4665 into 1.7640, 2.5869. In a similar way, you will find the spot rates, where you will take the spot values. So this is spot rate, and ultimately forward rates. The difference between the forward rates and the spot rates will give you the points. Now this is 0.0028 and 0.0012 in negative, but that's fine. This will be 28 and 12. Descending order, you will deduct. So this definitely requires a bit of practice when it comes to this swap points, cross rates. So 15 kind of plays around with market convention, swap points, selection of appropriate rates. So it's a good question for you to kind of probably try and practice. Okay. So next you go to the principles of arbitrage. So we'll proceed further onto the concept of arbitrage, where simply stated, arbitrage is the profit that you earn without bearing any risk and without making any incremental investment. If you earn a profit, well, that is a riskless profit, and hence that is called as arbitrage. Now in case of arbitrage, you can have various opportunities, like you can buy in the cheaper market, sell in the expensive market, like in the spot market. For example, in India, the dollar is available at 80. In the US, that same dollar is available at 82. Like you can buy in India and sell it in the US, make a 2 rupee profit. Or let us say in the 3-month forward market, the dollar is at 85, and in the 3-month futures market, the dollar is at 87. In which case I can buy in the forward market, sell it in the futures market, and make again a profit of 87 minus 85, that is 2 rupees. Now these are simple arbitrage applications. However, a much more interesting and complex arbitrage application would be something called as covered interest arbitrage. Now this is important as well as interesting. This forms the basis of what we call as interest rate parity theory. Now let us say the example that we discussed earlier, where in India you have the rate of interest as 10% per annum, in US the rate of interest is 2%, the spot rate now is 50 rupees per dollar, and if you were to apply IRP, the theoretical forward rate as per interest rate parity theory will be 53.92 as we discussed earlier. 50 into 1.1 upon 1.02. However, actually the bank is quoting a 55 rupees per dollar rate. Now looking at this, I can say that the forward seems to be inefficiently priced. Given a chance, you will sell it at an actual price of 55. So you will sell dollars in the forward market. However, you are an arbitrager. So if you want to sell dollars in the forward market, you need to have dollars with you, and hence in the spot market, you will buy dollars in the spot market. Now, if you want to buy dollars in the spot market, you need to have money with you. If you're an arbitrager, you don't have money, and hence you will have to borrow. So over here, if you want to buy the dollars, you will have to borrow, let us say rupees. So in today's market in India, so what will happen is, let us say you were to borrow 1000 rupees in India at a 1 year interest, that becomes 1100 of cash outflow loan along with repayment after 1 year. This 1000 you convert into dollars will probably become $20, and this you will deposit at the rate of 2%, and hence this will become $20.4, and this $20.4 you will convert at the actual rate of 55 which the banker is giving you. 20.4, let us say, into 55, 20.4 into 55, and you land up with 1122. So you will get a cash inflow of 1122. This is cash inflow, and hence there is a 22 rupees arbitrage gain. Now, how did we detect that there is a gain? There are various ways in which you can do that. One of the ways that we prefer doing is comparing the theoretical forward rate with the actual forward rate. If the actual forward rate is higher, we prefer selling at the actual forward rate. If you sell in the forward, you will buy in the spot, and if you want to buy in the spot, you will borrow. Or the other way is, let us say the theoretical forward rate was 53.92, actual forward rate is 51, in which case you would prefer to buy in the forward market, in which case you will sell in the spot market. But if you want to sell in the spot market, you need to have dollars to sell, so you will borrow in dollars and accordingly have this circle. This is what forms the base of interest rate parity, because if the rate is not 53.92 in the actual market, people will take these actions in order to earn an arbitrage profit. Now usually this poses a lot of challenges to students, where students find it difficult to kind of grasp and comprehend, and hence if you are unable to find these three steps, do trial and error. That's fine. There are exactly two routes which are possible. You either borrow in dollars or you borrow in rupees, and then try to find whether there's an arbitrage gain or not. That's it. There is no third possibility, and hence you will see doing both the possibilities. If there's an arbitrage gain or loss, if there is, then you can exploit that arbitrage gain and solve the question accordingly. So this is regarding covered interest arbitrage, which also forms the basis of a hedging called as money market hedging. So for the timing, if we try a problem on covered interest arbitrage, let us say if we were to go to question number 7, if I am not wrong, go to question number 7, yes. No, 7 no, I think question 4, yes. Go to question number 4. This is on page number 113 of your Super 90 set. Following are the rates quoted at Bombay for the British pound. This is bid and ask given to you. A 3-month forward, again bid and ask. And then you have 3-month rates in India and in the UK. Verify whether there is a scope for arbitrage if you borrow in rupees. Now, thankfully, you have been clearly told that you should borrow in rupees, but how many rupees they have not mentioned. So, let us say we were to start at around 1000, or let's say 10,000 rupees. If you were to borrow 10,000 rupees, today you have the rupees, you will want to convert this into pounds. So, if the base currency is a pound, we want to buy the pound, so the banker will sell the pound. The banker will sell the pound at the ask rate. Today, this is 52.7, and hence 10,000 divided by 52.7 comes to around 189.75 pounds. Now on this you will have interest for a period of 3 months in India. This is at the rate of 8%, so which means in India this will become 2%. Interest rate is percentage per annum, so this is 2%. So 10,200 will be your cash outflow. Similarly, in London for 3 months, 5%. So this is 189.75, and 5% of that into 3 by 12 comes to I think 2.37 pounds, and hence the total comes to around 192 pounds. Now this 192.12 pounds you will convert into rupees at this forward rate. Now what is a forward rate? There are two rates. You have the pounds, base currency is a pound, you want to sell the pounds, so the banker will buy the pounds, banker buys the pounds at 52.8. So if this is a 52.8 rate into, let us say, 192.12 into 52.8 comes to 10,143.9 or 10,144. This is my cash inflow, and hence the difference between the two is 10,200 minus 10,144, and hence this is 56 rupees negative. Cash outflow is greater, and hence there is no arbitrage gain. If there is no arbitrage gain over here, that does not necessarily mean there will be an arbitrage gain. If you were to borrow in pounds, you can even try to do that, and probably if there is an arbitrage gain, so be it. Otherwise, because there are different bid and ask rates, it may be possible there is no arbitrage gain either of the places. So if you are able to do this, let us say here they have taken I think 1 lakh. If you are able to do it for 3 months, there is a 558, or if 1 lakh was taken, or 56 rupees if 10,000 was taken. Try to pause and do if you want to for 6 months, and hopefully you should get this correct. Nothing new in the 6-month working, it is exactly the same. Okay, so that takes care of question number 4 as well. Now the next type of hedging over here is what you call as money market hedging. Now money market hedging is entirely based on the covered interest arbitrage principle. Like in the sum that we discussed, we said that theoretically the forward rate should be 53.92. Actually the rate is 55. Now you are not an arbitrage speculator, you don't like any of this, you are a simple importer. You want to protect yourself, you want to avoid your sleepless nights, and hence you want to take a forward cover. Forward cover is at 55 rupees per dollar. You are worried. However, the bank is not quoting at 53.92. So can you take certain actions in such a way that you develop an alternative to forward, which is called as money market alternative. So over here, what is the principles you will remember? You will ask yourself that, do you have a liability in the foreign currency or the asset in the foreign currency? So over here, at the end of the day, I have a payable. I have to pay to my supplier, for example, $1,000, in which case I will say that I have a liability in the foreign currency. So if I want to protect myself, what do I need to do? Sir, I need to have an asset in the foreign currency. So over here, I'll have to invest in dollars. Sir, how much will I invest? Well, in US, the rate of interest is 2%, for example. So I would say that if I invest 100 rupees at the start of the year, $100, at 2% interest, it will become 102. So if 1000 is equivalent to 102, then 100 is equivalent to how much? So probably I'll invest 980.39. But where will I get money to invest? Well, I will borrow in India. So I will borrow in rupees. So first, what is the first step always? If you get the first step, you will get everything else. Is there an asset in the foreign currency or liability? In this case, there is a liability. So you create an asset. That is, you invest. If you want to invest, you need the dollars. So how will you get the dollars? Well, you will borrow in rupees. How many rupees will you borrow? Well, at the spot rate, let's say at 50 rupees. So 980.39 into 50, and you will borrow 49,020 approximately, on which there will be an interest at the rate of 10%, and hence this comes to 53,922 or 921. So basically, for a liability of $1,000, you are ultimately going to pay 53,922 along with interest. At the end of 12 months, on the borrowing, you will pay 53,922, $1,000 that will be coming, you will hand it over to your supplier, and hence your effectively cash outflow is 53,922 for $1,000, that is approximately 53.92 per dollar. So you have developed an alternative to forward. If you went to the bank and agreed to a forward deal today, that will be at the rate of rupees 55, and hence you would be agreeing to pay 55,000 in actual forward, whereas under money market operations, you will pay around 53,922. So that is, let us say, money market hedging in case of an importer. If the same setup is to be done, let us say, for an exporter, so you have to again ask yourself that if you are an exporter, do I have an asset? You guys tell me, do I have an asset or a liability? Sir, we have an asset in the foreign currency because I have a receivable, which means I will have to create an opposite, that is a liability in the foreign currency, that is I will have to borrow in the foreign currency. Well, if I borrow in the foreign currency, that is I borrow in dollars, I have the dollars today. What will I do? I will convert it into rupees at the spot rate and deposit it in rupees. So over here, what will happen after 12 months? The debtor will pay me money and I will use that to repay my dollar borrowing. End of the story. So what I am left over is my cash inflow, which is completely hedged because the interest rates, the spot rate are clearly defined, and hence the deal happens at the money market hedging principles. So over here, we will try to review a question again on money market application, which is an extension, I would say, of your uh, of your covered interest arbitrage principle. So you look at question number 7. It's an interesting question, a couple of new insights that you can possibly get over here. So let us review question number 7. Now LMN exports its products throughout the world. It has today received an order from a regular customer in France for an order worth 3,50,000 pounds at today's spot market rate, clearly given. It has also received a new order from a customer in Uganda, 1,50,000 pounds, again at today's spot rate. Both orders, very important sentence, are to be paid in respective importer's currency. So what is the importer's currency? You will pay in that, they will pay in that currency. Terms of the trade are 60 days credit. No discount is offered for early payment. Experience has shown that the French customer may take 90 days to pay. Now, you might be giving a 2-month credit period, but if you believe that the payment is going to come after 90 days, then you will take hedging for 90 days, because that is when the cash flow is actually going to happen. Foreign exchange rates are given to you. So you have been given franc to the dollar and dollar to the pound rate. Also Ugandan shilling to the pound rate, and a few money market rates in percentage are given: US, Uganda, and UK. These rates are fixed for a period of 2 or 3 months. For immediate deposits, LMN converts all the foreign currency receipts into sterling. Sterling is like pound, which means LMN is like a UK company. Sir, but the invoice is in pounds. If it is in pounds, why do I need to convert it into pounds? No, it is in pounds at today's spot market rate. The orders have to be paid in the importer's currency, and hence the invoice is not 3,50,000 pounds. The invoice is in French francs if it is a French customer, which is at today's spot rate equal to 3,50,000 pounds. Okay, whenever possible, the company uses forward exchange contracts to hedge for the currency risks. In view of lack of forward markets in Uganda, the Ugandan customer is offered to pay $2,25,000 to LMN in 3 months' time instead of Ugandan shillings in 60 days. The customer is able to do so due to some liberalization policies. What are you required to do? Pound receipts LMN can expect from French customer using forward market, and expected pound receipts from the Ugandan customers, assuming the offer for dollar is accepted, assuming forward market hedge or a money market hedge. So in the first case, for a French customer, what do you need to remember? Here you are LMN. LMN is an exporter, and the invoice is 3,50,000 pounds at today's spot rate. Now, is today's spot rate available? Well, you want FF to the pound rate, which you don't have. You have FF to the dollar into dollar to the pound. So if I multiply that, this into this, you will have 5.7485 into 1.492 comes to 8.576, let's say 7 or 68. This is your rate. This is FF to the pound rate. 3,50,000 into 8.5768 will come to around 30 lakh 1,880. So this is your invoice for the French customer, 30 lakh 1,880. It is going to be paid in the respective importer's currency, so they will pay in francs. They will pay this amount after 90 days. Though the credit period is 60 days, they'll pay it after 90 days. So to protect myself, I will take a 3-month forward hedge. Again, for the 3-month forward hedge, I don't have FF to the pound rate, but I can use the cross rate principle of 5.7833 into 1.4873 and get around 8.6015. Again, this is FF to the pound, and hence FF has to get cancelled. 1 upon FF, 8.6015 to the pound. FF gets cancelled. Your answer is going to be in pounds, comes to around 3,48,000, around 995 or something pounds for the French customer. Now for the Ugandan customer, whatever be the invoice in Ugandan shillings, we are agreeing to receive US dollar 2,25,000. So for all practical purposes, whether the Ugandan customer is paying or someone else is paying, I am getting US dollar 2,25,000 after 90 days, that is 3 months. And hence I will look at the FF to the dollar rate, which I have. So for forward hedging, it is very easy. I will say dollar 2,25,000, dollar has to get cancelled. So over here, we need to look at dollar per pound rate. So over here, 1 divided by dollar 1.4873, 1.4873 to the pound, and hence 225 upon 1.4873 1.4873 comes to around 1 lakh. 225 upon 1.4873, 151, 280 approximately, 281. So this is your forward cash flow. Now the problem is using money market. You have to ask yourself whether you have an asset or a liability. Well, I have an asset, I have a receivable in the foreign currency of $2,25,000. However, if I have an asset in the foreign currency, I will have to create a liability, that is I will have to borrow in dollars. How much will I borrow? Well, if I borrow in dollars, that is from a US bank, the borrowing rate is 6%. 6% is per annum. So for 3 months, it is 1.5%. So this is 100, then 101.5, 225 divided by 101.5 comes to around 2,21,000. So this is, let us say, around 221,675, let us say. This is 675. You will convert this at the spot rate, dollar to the pound rate, which is 1.4920. So this is dollar 1.4920 to the pound. You will divide this. So this is divided by 1.4920, and hence you will get 1,48,575 or 576 pounds, which you will deposit in the UK on 5%, that is 1.25%, and hence 1857. So you will add 1857 to 148,576. This will come to around 1,50,433, and this will be your cash inflow. Now you will prefer a higher cash inflow, and hence you will try to hedge using forward in case money is going to be received in dollars. Point 3, to advise element on whether Ugandan customers offer for payment in dollars should be accepted. If not dollar, then well, Ugandan shillings. You want to protect yourself. So if you accept Ugandan shillings, you will take a 2-month forward, but well, there's no forward hedging possible in Uganda, and hence forward hedging is not possible. Okay, then go to money market. Well, you have an asset in Ugandan shillings, so you will create a liability in Ugandan shillings, that is, you will borrow in Ugandan shillings. Well, if you know, if you go to Uganda, you can't borrow in Ugandan shillings, and hence money market hedging is also not possible. So over here, given a choice, it is not possible to hedge your exposure in Ugandan shillings, and hence it is advisable to kind of take the position in dollars, hedge yourself. In any case, Ugandan shilling is a much more volatile currency as compared to the dollar, so it is advisable to take the position in the dollars. Okay, so that takes care of this question regarding money market. It's a fairly interesting question. Now, next type of hedging is, or there is also something called as a leading and lagging. So what is leading? Leading means prepayment, usually comes with a cash discount. Cash discount is a flat discount. So over here it may be that if you were to pay the money upfront, you get a 2% discount. So $100 ke badle you will pay $98, but you will pay it upfront into the spot rate. This cash outflow will be cash outflow today. You can't compare it directly with the forward or money market, which cash outflows happen in the future, and hence time value adjustment might need to be done. This time value adjustment will be at the rate of interest, which is the borrowing rate of interest in your own currency. So usually there will be multiple rates. We will say what is cost of capital. Cost of capital is like the borrowing rate, KD, in your country and not in some other country, and hence unless given otherwise, you will always take the time value adjustment at the borrowing rate in your own currency in case there is a leading option. Lagging goes the other way around. In case of lagging, you are postponing payment. If it was 3 months, you are saying that I will pay it after 5 or 6 months. Again, there will be a time value adjustment. We will see how to do that. But leading and lagging are either paying early and availing a cash discount, or paying late and probably paying some interest and playing on the time value. Okay, next you have this section on currency futures. Now this is important because this is also going to have some spillover effect in derivatives. So when you look at currency futures versus forwards, theory level pe, what is the difference? In case of forwards, these are customized, tailor-made contracts with standard expiry dates and standard amounts. Sorry, with customized expiry dates. If you want an expiry on 10th of February, you get an expiry on 10th of February. For $1,02,000, you get it on $1,02,000. However, when you look at a futures contract, it is standardized. It will expire, let us say, by the end of each month, in which case, whether you want delivery on 10th February, 15th February or 25th February, the futures will expire at the end of the month. Again, there will be standard sizes, like for example, $10,000, there will be a standard lot size, and as a result, futures will be standardized contracts. However, the advantage of a future is it is highly liquid. In case of a forward, if you want to exit the forward, you have no route. maybe we'll see how to cancel using reverse forward, etc. But in case of a future, we can just call up the broker, take the opposite position. If you have bought the futures, you will sell them. If you have sold the futures originally, you will buy them. Futures, unless given otherwise, will always net settle on the exchange. That is, when you take a forward contract at the rate 82, after 3 months, you will go to the bank and you will pay 82 rupees per dollar into, let us say, $1,000. That is, you will pay 82,000 rupees and get $1,000. Actually, however, exchange is not going to give you actual dollars. Exchange will say that you entered into contract at 82. We will do what is called as a mark-to-market settlement. So we will say that you agreed into a contract to buy at 82. Today the price is 85, and hence you have entered into a contract which will give you 3 rupees of cash inflow. So over here, 85 minus 82, that is selling price minus cost price. If you had originally bought, you will cancel by selling it. 85 minus 82, that is 3 rupees per dollar into $1,000. 3 rupees is a net gain that you will get from the futures position. If you are an actual importer who wants to pay the dollars, you will have to go to the spot market and buy those dollars, because the exchange in general, unless given otherwise, is not going to do a gross settlement. It is going to give you the net amount. So then why do people do futures? To be honest, very few people do futures in currency. Most of the people who are importers, exporters will actually do a forward with the bank. However, for futures, people do for liquidity purposes. So if you want to exit, you can easily exit, and to avoid the counterparty risk. So in case of a future, what does happen is the counterparty is the exchange, and as a result, we are kind of much more confident of the settlement terms, because the exchange will almost always settle. So when a typical currency futures question comes, how do we solve a typical currency futures question? There are a few steps that you will have to remember. Step number 1 is you will compare the invoice currency, for example it is in dollars, with the futures contract currency or the base currency in the future quote. Let us say there are two possibilities. It is either in the same currency, that is dollars, or it is in some other currency. So your invoice currency, first step is your invoice currency being same. Second possibility is the invoice currency is different. Sir, what do you mean by different? Well, your invoice, for example, is in dollars. However, the futures contract size are given in rupees on a per rupee basis. We'll see how to solve for that. Second step is always formulating the strategy. How do you decide the strategy? Well, the invoice is in dollars, contracts are also in dollars. So you will think that what do we do? Well, if you are an importer, let us say I'm going to buy the dollars. I'll buy the dollar futures. I need the dollar in the future, so I'll buy the dollar futures. Next, you will select the maturity. When you select the maturity, well, there may be various maturities. You will select the contract which covers your expiry date. Let us say you want on 20th February. So a contract which covers 20th February and is nearest. So if you, for example, have a December contract, a March contract and a June contract, which one will you take? Well, ideally I would love to take a contract maturing on 20th February, but I don't have that. I have a December contract maturing, March contract maturing and June contract maturing. December contract will mature by December, and hence I will be exposed to risk over the next 1 or 2 months. The March contract will be alive on 20th February. Even the June contract will be alive on 20th February, but June contract will be subjected to a lot more uncertainties because it is going to expire till June, and hence you will take a contract which is nearest to your maturity, which is, for example, March contract. So over here you will enter into a March contract. Next, you will figure out the number of contracts. How do you calculate the number of contracts? You will take the invoice. Let's say invoice is in dollars, divided by the contract size, which is also in dollars, to find the number of contracts. Now things go smooth over here. However, if the currency is different, then again the strategy will change. Like you want to buy dollar futures. However, the contract, futures contract is not in dollars. It is, for example, in rupees. In which case, you will say that if I want to buy dollars, on one hand I am buying the dollars. That implies on the other hand I am paying. That is selling the rupees, buying dollars. That is, your actual contract will be sell rupee futures. This would be your strategy. Sir, how does it matter? Well, cost price or selling price depends on whether you have decided to buy or sell. Next, you look at, for example, maturity. Again, the maturity will be same, covers and is nearest. So this is March. But now when you sit to calculate the number of contracts, your invoice is in dollars. For example, $1,02,000. But your futures contract are in rupees. You can't divide that, and hence you either convert the invoice into rupees by taking the futures rate, or convert the futures contract size into dollars, again taking the futures rate. So over here you will have to convert that and then find the number of contracts. We'll do that in a sum to get a better understanding. And then comes the problem of settlement. So in case of settlement, if I'm an importer, I don't have a choice. Exchange is not going to give me dollars, so there will be some cash outflow at today's spot. But then there will be a gain or a loss in the futures contract. How do I calculate the gain or loss? Sir, my original contract was a buy contract. I will cancel it by selling it. The selling price over here will be the futures price on the date when you are settling the contract. Let's say 20th February. The contract is going to mature on March. However, I don't need any exposure beyond February. So I call up my broker and sell the contract on 20th February. Selling price minus the cost price into. So this is on a per unit basis into the contract size, let us say for example $10,000 into number of contracts, let us say 10, and hence you will get your answer most likely in rupees. However, the same principles if you apply, if the currency rates were different, the problem is your selling price and cost price. Okay, you have entered into a contract to sell, so your selling price is let's say $0.0125 per rupees minus let's say when you are cancelling the cost price is $0.0115 per rupees into when you multiply this, you will multiply this by the contract size which is in rupees into the number of contracts, and hence rupees and rupees will get cancelled. Your answer will be in dollars. You will have to convert this at the spot rate on the date when the settlement is happening. Best understood if you try to do it with a sum, with a problem. So this is how the 4 or 5 steps are going to work. First, you compare whether the invoice and the futures contract are in the same currency. If yes, great. If no, be a little more careful at 3 levels: the strategy, number of contracts, as well as settlement gain or loss. Next step is strategy. You decide if you are an importer, if you want to buy the dollars and the contracts are also in dollars, buy dollar futures. However, if the contract are in rupees, you want to buy the dollars, but buying dollars is equivalent to selling the rupee, and hence you will enter into a sell rupee futures contract. Maturity nearest and covering your maturity. Next is number of contracts, invoice value divided by contract size. If it is in the same currency, great. If not, then you will convert one of the two and then find the number of contracts. The conversion happens at the futures rate. If they are in decimal, you round it off to the nearest number typically. And when you are doing settlement, cash outflow, if it is cash outflow, you show it as negative. Cash inflow, you show it as positive at the spot rate. Importer will have a cash outflow, exporter will have a cash inflow, and then you will find a gain or loss in the futures position. Selling price minus cost price into the contract size into the number of contracts. Ideally, that will give you the gain, but you have to see which currency the gain is coming in. If it is coming in your own home currency, no problem. If it is not coming, you will have to convert it. What rate? Spot rate. We will do it in a sum and you will get a much more clearer understanding. So this is a question on currency futures. We will go to question number 8. There are 2 or 3 other things. It's a fairly interesting question. There is bid and ask with different rates, a lot of interesting things over here. So definitely an important question. Question number 8. Now Nitrogen Limited is a UK company which is in the process of negotiating an order amounting to 4 million euros with a large German retailer on a 6-month credit. So money is going to be received after 6 months. If successful, this is the first time that Nitrogen will be exporting goods to the highly competitive German market. So Nitrogen over here is an exporter. The following 3 alternatives are being considered for managing the transaction risk before the order is finalized. First, the invoice a German firm in pounds using the current exchange rate to calculate the invoice amount. Best, if you are invoicing in pounds, you are Nitrogen, which is a UK company, you don't need to worry about the risk. You don't need to do any hedging because the invoice is in pounds. The customer will pay you after 6 months, yes, but they will pay you in pounds. So here no hedging is needed. But how many pounds? We'll see that. Second alternative, invoicing the German firm in euros. Okay, how many euros? 4 million euros. And using a forward exchange rate contract to hedge the transaction risk. Okay, so this is invoicing in euros, but you will use a forward contract. And last is invoice the German firm in euros and use sufficient 6-month futures contract to nearly the whole number to hedge the transaction risk. Point C is futures, point B is forwards, point A equivalent invoice value if the invoice is in pounds. You are given spot rate, unfortunately bid and ask being given. But what is the base currency over here? The base currency everywhere is a pound, and hence the bid and the ask rate that you select should be based on the pounds. 6-month forward premium is given to you. This is given in euro cents. Cents, remember, 100 cents make up 1 euro, like 100 paisa make up 1 rupee. So 0.6 cents actually means, if I go to see in euros, 0.0060 euro, and 0.55 cents, half a paisa, equals approximately 0.0055. Remember, this is given in descending order, D for descending, D for deduct. 6 months futures contract is given to you. Futures contract size is given to you in pounds. spot rate and the 6-month futures rate is also given to you. Calculate to the nearest pound what nitrogen will receive in the 3 proposals in your opinion, which is the best proposal. So over here, what will you do? We'll first try to look at the forward. Now forward, we will first have to find the forward rate. Now how do you find the forward rate? Well, you look at the swap points, adjust it with the spot rate. So over here, if your spot rate was euro 1.1750, what will I do? So this is given in descending order and hence I will deduct. So this is 1.1750 minus 0.006 comes to 1 point. Euro 1.169 and second case 1.1770 minus 0.0055 euro 1.1715 to the pound. Now you have been given for question 8, let us say the 6-month forward rates. They were not directly given, but you could have calculated it. This is euro 1.1690 to the pound and euro 1.1715 to the pound. Now in either case, your base currency, you can convert this into direct quote, indirect quote if you want, if you have done that method, but what I prefer is you find out what is the base, that is the denominator of the exchange rate code, that is a pound. Now what does nitrogen intend to do? Well, nitrogen is an exporter, nitrogen intends to receive the euros and hence nitrogen intends to sell the euros. You guys think and tell me, can I make my bid and ask decision based on the euro? No, because the base currency is a pound. Achha, if you as nitrogen want to sell the euro, that means on one hand you will sell the euro, on the other hand you will receive, that is buy the pounds. So since the base currency is in pounds, your decision has to be based on pounds. If nitrogen is buying the pounds, what is the banker doing? So the banker is going to sell the pounds and hence the transaction happens at the pound ask rate, which is 1.1715. Now Institute has also correctly done this. So if I look at under the forward contract, cash inflow which will come after 6 months will be pound, euro, I think 4 million, that is 40 lakhs. Now whether I multiply or divide, well, that depends on in which currency I want my answer. I want it in pounds, so euro has to get cancelled. So I will divide 1.1715 to the pound. So your euro and euro gets cancelled. Your answer is in pounds. 40 lakhs divided by 1.1715 comes to around 34 lakh, 14,426 pounds. Okay, so this is your cash inflow. Now one can always say, sir, if you are taking inverse of the ask rate, it will become the bid rate. That is right, it will become the euro bid rate. So had I taken euro as my base currency, I will ask myself that what do I want to do? Well, I want to sell the euro. That means the banker wants to buy the euro. That is a euro bid rate. So the rate is the same. And hence 34 lakh 14,426 will be your cash inflow under the forward. Now if I look at the futures contract, my invoice, in this case, if I look at the futures, my invoice is in euros, but your futures contract is 62,300 or 62,500 pounds and hence it is in a different currency. So again this problem arises that what should I do? Well, strategy, ideally I want to sell euro futures. However, the contracts are denominated in pounds, so buying and selling is dependent on what you want to do with the pounds. If I want to sell the euros, on one hand I am selling the euros, that means on the other hand I must be buying, that is buy pound futures. That is buy pound futures. So this is my strategy. Second, I look at maturity. Now there is only one maturity, the 6-month contract, which is available at euro 1.1760 to the pound. If I am going to buy pound futures, this is like my cost price, and then I want to find the number of contracts. Now while finding the number of contracts, I will look at my invoice, which is 40 lakh euro. Now the problem is this is in euros. I will divide this by the futures rate of 1.1760 because you are entering into a futures deal. So this is 40 lakhs divided by 1.1760. Remember, you can also adjust the contract size and get around 34 lakh 1,361 pounds divided by 62,500, the contract size, which is also in pounds, 62,500, and hence this is 54.42, that is 54 contracts. So you will enter into 54 contracts. Now on settlement, when the settlement happens, sir, 6 months later, on settlement you are an exporter, you will actually receive the euro. So you will go in the spot market and you will sell the euros. So 40 lakh euros at the spot market. 6 months later, coincidentally, the future and the spot rate is the same, 1.1785. So you will say, I want my answer in pounds. So this will be 1 divided by euro, 1.1785 to the pounds, and hence 40 lakhs upon 1.1785. So this comes to, I think, 33 lakh 94,145. Now there is some gain or loss on futures. Gain if positive, loss if negative, cash inflow if positive, cash outflow if negative. So I will take selling price minus cost price. My original contract was a buy contract that I had entered at 1.1760, that is a cost price. Now I'll call up my broker and cancel, that is sell the contract, and when I sell it, that is going to be at 1.1785. So over here, euro 1.1785 to the pound, this is the selling price, minus euro 1.1760 to the pound. This is like the cost price. This is per pound into 62,500 pounds into 54 contracts. If I go to see, that means my pound and pound will get cancelled. If I look at my number 1.1785 minus 1.1760 positive into 62,500 into 54, I see a number 8437. Most of the students will leave it over here, but this is 8437. What, sir? This is euro. I want my answer in pounds, and hence I will divide this by euro 1.1785. That is the spot rate per pound, 1.1785, and hence 7159 or 7160 positive, because it is a gain, and that will give me my final answer. Now in case there was margin, like if there was a deposit to be made, we will then have to find the interest cost on the deposit and then figure out my final cost. So over here 3394 145 or something plus 7160, and you are at 34 lakh 1000, still lower than the forward, and hence given a choice between these two, we will ideally prefer the forward. However, there is one more option over here, that is you can directly invoice in pounds, but at which rate? At current rate. So think of it this way, how will you decide what rate to use? We will say that for a European customer, you will say that a European customer had to pay euros. So over here, if now instead of paying euro, you tell him that you have to pay pounds, they will say, okay, that means I need to buy the pounds. So as a European customer, a customer would say, I need to buy the pound so that I can pay you. Acha, what is the base currency? Sir, the base currency is the pound only. I want to buy the pound. That means the banker will sell the pound, and hence the transaction happens at the pound ask rate. Pound ask spot rate. That is 40 lakhs into euro 1.1770, if I am not wrong. So this is 40 lakhs divided by 1.1770 comes to around 33 lakh 98,471. Yes, I will receive this money after 6 months, but I will receive 33.998 lakh pounds as compared to forward, which gives me 34 lakh 14,000 certain. And hence I would prefer the forward option over here. So it's a good question. I would definitely review this, because you have bid and ask. Again, base currency is a different currency. Futures as well, where futures currency is different. So maybe if you are doing this after a long time or listening over here for the first time, there will be some resistance, but if you practice this, hopefully things should flow in place quite well. Now that was question number 8. Now before you proceed further, there is also another concept in futures which is called as basis. Basis is called as the difference between spot and futures. So sometimes an MCQ might come on basis. Basis refers to the difference between spot and future. So if your spot rate was, for example, 50, future rate is 55, then basis is a negative 5. When basis is negative, that situation is called as a contango. When the basis is positive, that situation is called as backwardation, just in case it comes for an MCQ setup. Then there are a few other concepts like netting and matching, where sometimes you can decide that rather being an importer and an exporter both, you had to pay $7 lakh, you have to receive $4,50,000. Now rather than you paying $7 lakh, receiving $7,50,000, taking two separate forward contracts for the same, you can probably net your exposure and say $7 lakh minus 4,50,000, that is 2,50,000 additional dollars that are needed. I will take just the forward cover for that. That netting and matching can be done for the purpose of exporter-importer transactions. It can also be done in case of treasury or cash management, where you have money in different currencies. The question might be to keep the money in those currencies and then convert it later at the forward rate, or to convert everything today and then deposit in your own currency rate. So whichever gives you a higher cash balance eventually should be taken. So there are a few cases of netting and matching. Currency swaps. What does the word swap mean? Swap means exchange. Like for example, there's a company Mahindra, who is an Indian company, and a company Chrysler, who is a US company. Chrysler is quite popular in the US, not as much in India. Mahindra is very popular in India, not as much in US. Now Mahindra wants to set up a plant in the US, so it wants borrowing in dollars. But US banks don't know Mahindra as much, and hence they are charging a higher rate of interest. Chrysler wants to set up a plant in India, it wants borrowing in rupees. Indian banks don't know them so well, and hence charging a much higher rate. So what do? They say that, well, we need almost equal amount of money. So Mahindra can borrow in India in rupees and get a favorable interest rate. Chrysler can borrow in the US in dollars and get a lower rate. Swap, that is exchange those amounts, and then at each date, as per the agreement, Mahindra will pay the Indian bank the rupee interest, Chrysler will reimburse that, and in turn Mahindra will pay Chrysler and Chrysler will pay the US bank. So this will help in overall reducing the transaction cost. Currency swaps are relatively less important. I would say interest rate swaps are more important from an exam perspective. But in case currency swaps do come, there's question number 3 that we have kept. So review question number 3, please. Let us go to question number 3. This is a question on swaps. That is exchange. Now AINC and BINC. In a swap, what will happen? Before you proceed, in a swap, what will happen? In a direct borrowing, Mahindra will directly pay to the bank where it has borrowed. That's it. But in a swap, what will happen? There is Mahindra, it will pay to the bank from which Mahindra has borrowed. Further, it will receive some money from Chrysler. Further, it will pay some money to Chrysler. So your net cost will comprise of these 3 items: payment to your bank minus receipt from the other entity plus payment to the other entity. That will give you your final cost. And ideally, if the swap has to be advantageous, this final cost has to be lower than the cost had there been, for example, no swap and you directly had borrowed. So that is question number 3, an interesting and an important question as well in my understanding. So let us review this. AINC and BINC intended to borrow $2 lakh and $2 lakh in yen respectively. So A probably intends to borrow $2 lakh, B intends to borrow $2 lakh in yen equivalent for a time horizon of 1 year. The prevalent interest rates are as follows for A and B. For a yen loan as well as a dollar loan, the prevalent exchange rate is $1 is equal to 120 yen. So basically $2 lakh in yen will be 2 lakhs into 120 comes to around, I think, 2 crore 40 lakh yen. Okay. They entered into a currency swap under which it is agreed that B will pay A. They enter into a currency swap. Now currency swap means A, which intends to borrow in dollars, will actually not borrow in dollars. In fact, it will borrow in yen. And B, which actually intends to borrow in yen, will actually borrow in dollars. Swap, opposite. They intend to swap under which it is agreed that B will pay A 1% over the yen interest that the latter, that is A, will have to pay as a result of the agreed swap, whereas A will reimburse interest to B only to the extent of 9%. So this is agreed. How they agreed? Based on negotiations. Keeping the exchange rate invariant, that means same, quantify the opportunity gain or loss component of the ultimate outcome resulting from the designed currency swap. So first what you will do is you will structure the swap. There is AINC, there is BINC. It is clearly given that A desires to borrow in dollars, that is under the desired borrowing. However, under swap it will take the opposite borrowing, so it will take a yen loan, whereas B wants to borrow in yen, so it will have to take a dollar loan. Acha, for B, if B were to take a dollar loan, it will cost B 10%. If A were to take a yen loan, it will cost A 5%. Okay, apart from that, so I will have to pay A will have to pay the 5% in yen, B will have to pay the 10% in dollars. Apart from that, it is agreed that B will pay A 1% over the yen loan rate of interest which A will have to pay. So B will agree to pay a yen 6%, that is 5 plus 1 in yen, whereas A reimburses B only to the extent of 9%, let us say in dollars. So this is your swap agreed. Now I can do the working for A, and if you are comfortable, you should actually try to do the working for B on your own. We will say that A is a swap beneficial. Well, under the desired borrowing, what is the cost? Well, under the desired borrowing, A would have directly borrowed $2 lakh. That's it. $2 lakh. At what rate? A would have borrowed at the rate of 9%. End of story. And hence the total cost would have been 18,000. Now, under the swap, A takes three positions. First, it has to pay to the bank of A, which is yen 2 crore 40 lakhs into 5%. This is a cash outflow. 2 crore 40 lakhs into 5% comes to 12 lakh. This is yen. I will have to pay this 12 lakh yen. Further, B reimburses that. So received from B 2 crore 40 lakhs into B is going to reimburse to the extent of 6%. So over here, probably you are going to get back 14 lakh 40. This is a cash inflow, and hence I will get a net cash inflow of yen 2,40,000. However, A wants to see whether it is advantageous in dollars or not. So keeping the exchange rate invariant, you will divide it by the exchange rate, that is yen 120 per dollar, and hence this comes to what? 2,40,000 upon 120 comes to $2,000. That is my net cash inflow. However, apart from that, it will also have to pay to B. It agrees to pay to B $2 lakh at the rate of 9%, and hence it will pay, for example, 18,000 to B. However, it is going to receive 2,000 net cash inflow, and hence the net cash outflow is 16,000 for A. Now this is lower than the cost under the desired borrowing, and hence the swap is beneficial for A. Now if I look at payment for B, for example, for B, you can pause and try on your own if you want, but if you look at payment for B, B has to pay what? Well, B has to pay dollar loan, 10% of 2 lakhs, $20,000. Under the swap, B will pay $20,000, but it will receive something from A at the rate of 9%, and hence it will receive $18,000. So there is a net cash outflow for B at $2,000, which at 120 ka rate will be what? 2,40,000. So B will have to net pay 2,40,000. Apart from that, B will also have to pay, let us say, A. And when I look at payment to A, it will be, I think B is paying to A how much? 6% of 2,40,000, that 2 crore 40, that is, I think 14 lakh 40, and hence the total cash outflow for B will be 16 lakh 80. 16 lakh 80 you compare with the cost of a direct borrowing, where B would have borrowed 2 crore 40 lakhs at the rate of 8%, costed B 19 lakh 20, and hence there is an advantage, a gain to be under the swap. So this is a slightly complicated working, but if you have to kind of compare, you will take the cost of the desired borrowing, which you can directly calculate, with the cost under swap, which is pay to the bank minus received from the counterparty, net amount whatever it is, apply the exchange rate of exchange, and this will give you net payment or received. So this is 1, this is 2, but you still have to pay to the counterparty. This is the third part, and together this will give me the total cash outflow. Are we clear with this? Is everyone clear? Okay, so this is kind of swap, a bit of practice, and it should be ideally smooth sailing. So that takes care of currency swaps. Next you go to currency options. Now currency options, again, there are two types of options. There is the call option, that is a right to buy, put option, that is a right to sell. Again, the working over here will be similar to that of futures, where first you will compare what is your invoice currency with the contract currency. If available, if contract currency is not available, you look at the strike price, base currency in the strike price. You will see that if your invoice is in dollars, but your Your strike price is per rupee. That means it is in different currency. That is, the contract size is in a different currency. If it is same or if it is different. Acha, if it is same, then you will do it logically. Like, you are an importer, you want to buy dollars, the strike price is rupees 80 per dollars, and hence you will say that I want to buy dollars. That means I will take the call option, I will buy, go long the call option. However, you are still an importer, you want to buy the dollars, but the rate is $0.025 per rupees. So if you still say I will take the call option, that means you are taking a right to buy the rupee. It is $0.025 per rupee. So you're taking the option to buy the rupee. Yeah, but I don't want to buy the rupee. I'm an importer. I want to buy the dollars. Okay, that means you want to buy the dollars. That means you are selling the rupee. Selling the rupee means you will enter into the put option. So this is where you will probably make a mistake when it comes to options. Selecting call versus put, here you will always go long because you're a hedger. You will not take a short position, you will go long. But when you go long in general, unless otherwise given, you will ask yourself that is the invoice currency and the contract currency the same. If they are the same, logical working, you want to buy dollars, buy the call option. You want to sell the dollars, sell the put option, buy the put option. However, if you are an importer, you want to buy the dollars, but the base currency is the rupee. In which case, you want to buy the dollars, but the base currency is the rupee. Buying the dollars on one hand is equal to paying the rupee on the other hand. And hence, you want to sell the rupee. Selling the rupee is like buying the put option on the rupee. And hence, you need to be careful over there. Second, again, the maturity, nearest maturity, you should take the contract which covers your maturity. All principles remain the same. Number of contracts, again, the same thing. Invoice divided by the contract size. If it is in different currency, convert it at the strike price and find the number of contracts, round off to the nearest number, everything being the same. Now the cash outflow over here is taken as a sum total of three parts. First, you will try to find the cash outflow on the hedged portion, which is covered by the option. Second, unhedged portion, for which the question might tell you to take an expected spot rate, futures rate, forward rate, whatever it is. Let's say $1,02,000, you are getting option for $1 lakh, remaining $2,000 remain unhedged. You find the cash outflow for $1 lakh separately and for $2,000 separately. $2,000 is usually at the expected spot rate or the forward rate. $1 lakh is usually at the strike price or the spot at expiry, whichever is favorable for the option holder. Like if you are buying the call option is the right to buy. You will buy if the spot at expiry is greater than the exercise price. So if the rate is 80, 90, 95, and you have an option to buy at 75 the dollars, you will buy it. Or if the rate is 60, 65, you will not buy the dollars at 75. So that is what creates a bit of a problem. Similar is the case with put option. And third part is the premium. The premium over here, one needs to remember, is to be paid upfront and is non-refundable. But the problem is cash outflows under the hedged and the unhedged portion, as well as other options which you have to compare, are going to happen, let us say, at a later date, and hence you will have to do a time value adjustment on the premium if data regarding interest rate is available. So that is something that you have to be a little careful about. This is regarding currency options. If you were to hedge, there might be questions which are largely derivative questions where you might also need to, you might have a slightly speculative position, in which case you will again have to find the gain or loss in such a case. Okay, so let us try doing a few problems over here where you not only revise for currency options but also other like futures or forwards or money market, for example. Okay, so question 9, 10, 11, 12, I think these are on fate of forwards. We will directly go to question number 12 for the time being. This is on currency options and a situation where you are a speculator. Okay. On 19th April, following are the spot rates: spot Euro USD, USD INR. Now, what do you guys think? This USD INR is rupees per dollar or dollar per rupees? So, this appears to be as per market convention the other way around, that is rupees per dollar. Similarly, if one of them is going the other way around, then Euro USD. Again, it makes sense that this is dollar per euro because for every euro you get more of dollars. So this is one problem area. Following are the quotes for European options. You have the call and put. Strike price is given to you, premium is given to you, and expiry date. This is July 19 for the Euro USD contracts, September 19 for the USD INR contracts. So this is an overlay between derivatives and Forex. I would think that this is more like a derivative question rather than a Forex question, but nevertheless. Point 1, a trader sells at the money means spot today equals to the exercise price. That is when it is called as at the money. What is the spot today? Sir, spot today is 1.2 and 44.8. A trader sells at the money spot straddle. Now what is straddle? One call plus one put. This is called as a straddle. Expiring in 3 months. That is July 19. Achha, which contract expires in 3 months? The Euro USD contract or the USD INR contract? Sir, the Euro USD contract, and hence this is the data given for the dollar per euro contract. Calculate the gain or loss if 3 months later the spot rate actually turns up to be 1.29. So basically here you have to calculate something called as payoff that you do in derivatives if you have done derivatives. So over here you will have one call, one put, but the trader is short the straddle, which means you are an option writer. You have not purchased the call, you have actually sold the call. So you will ask yourself that when will the exercise happen? For the call option, what is the strike price? The strike price is 1.2. Call will be exercised if the spot at expiry is greater than the exercise price, that is 1.2. Whereas put will be exercised if the spot at expiry is less than the exercise price, that is 1.2. That is when the exercise will happen. So over here we will say that for call, the spot at expiry is how much? It is given to us 1.29, and hence will the exercise happen? The answer is yes. Remember, you are not the holder, someone else is the holder, but if holder exercises, you will have to oblige. Will the put be exercised? No. The holder has a chance to sell at 1.29, it will not sell at 1.2. And hence, if you find the payoff, how will the payoff be calculated? Well, you will say that this is $1.29 per euro minus $1.20 per euro. So basically I don't know how much is there, so let us say this is into 1 euro, and hence this will be $0.09. Now you are short the option and hence you are an option writer. Payoff is negative. In the second case, payoff is nil. However, there is some premium. You must have received the premium, so you will keep this positive. So the premium received is 0.035 and 0.04. So you will add 0.035, add 0.04. So if I look at the net payoff, there's no interest or any other adjustment, but in any case in payoff you don't do that. 0.09 negative plus 0.035 comes to negative 0.055, and hence this is a net loss of $0.015. That is your net loss in the first case. Second, which strategy gives the profit to a dealer if 5 months later, September 19, September 19 is what? The USD INR, rupee to dollar contract, expected spot rate is rupees 45. You are expecting 45. What is the spot rate today? 44.8. Spot rate today 44.8. That means you are expecting the price to go up. Usually when you study derivatives, you will be taught that buying a call is a bullish strategy. You will generally buy a call under a bullish market, because if you expect the price to go up from what it is currently, then call is much more advisable. Put, you say, is a bearish, that if you are afraid that the price is going to go down and you want to assure your cash inflow, so you sell, get a right to sell. So put is a bearish strategy, whereas call is a bullish strategy. So generally over here, if you have the money, you will buy the call, that is you will go long the call option. If you buy the call for a transaction value of $1.5 million, that is 15 lakhs, over here on expiry your payoff would be rupees 45 per dollar minus you have agreed to buy it rupees 44.8 per dollar. So 0.2 per dollar into 1.5 million. 0.2 into 1.5 million comes to 0.3 million, that is around $3 lakh. No, 3 lakh rupees. Dollar gets cancelled, answer is in rupees. But this does not come free of cost. This comes at the cost of a premium, which is $1.5 million into rupees 0.12 per dollar. So 15 lakhs into 0.12 comes to 1,80,000, and hence you earn a cool 1,20,000 in this. This is if you have the money. However, if let us say you are an article clerk, you don't have money, then first of all you should not go into the futures and options market. But let us say if you decide to go into the futures and options market, how will we arrange $1,20,000 for premium? It is difficult for us. Another strategy that you can possibly use is, you will say that, well, you know what, I would ideally love to buy the call because it is likely to be exercised, but then the put option is unlikely to be exercised, so I will not buy it, but then I can sell it. If I sell the put option, I will receive the premium of 0.04 into 15 lakhs, which will possibly come to around 60,000. I will receive that premium, and ultimately if the price actually turns out to be 45, it will not be exercised, and hence I'll not have any payoff. 60,000 will be my gain. So even if I don't have money to invest, maybe I can short the put and get the gain. Here I'm going long the call and making a 1,20,000 gain. So this is question number 12, a little tricky, involves application of derivatives. Then you have question number 13, and then I think question number 14. Both of these are option questions which are a little complicated. Let us review question number 13 once. XYZ, which is a US firm, will need 3 lakh. XYZ is a US firm, will need 3 lakh dollars in 180 days. Why? Probably it has to pay someone. In this connection, it will need money. In this connection, the following information is available: spot rate, 180-day forwards rate, interest rate is given. Let us say this is flat rate. Ideally, if nothing is given, you assume the rate of interest as percentage per annum, but for this and this sum only, institute for some reason has taken a flat rate. So we are just clarifying and saying that this is 4.5% flat, 5% flat, and not a percentage per annum. This is a big problem in the institute solutions, whether I should take interest rate on a per annum basis or should I take the flat rate. Most of the sums are taking interest rate on a per annum basis, but one of 2 or 3 sums here or there, they have taken flat as well. Different examiners, different paper setters have done it differently, and the student kind of suffers. But well, as of now, let us say for a concept base, hopefully in our exams you will be clearly given that it is percentage per annum. Unless otherwise given, you will assume it to be percentage per annum. A call option on the pound that expires in 180 days has an exercise price of 1.97 and a premium of 0.04. XYZ has forecasted the spot rates 180 days as below. So you have been given 3 different possible rates. Which of the following strategies would be most preferable to XYZ? Now, who is XYZ? Well, XYZ is an importer who has to pay 3 lakh pounds. First, a forward contract. Well, 3 lakh pounds under the forward contract, the forward rate is given to you as 1.96. $1.96 per pound. 3 lakhs into 1.96 comes to 5 lakh 88,000 dollars. This will be your cash outflow under forward. Second is money market. Under money market, what do you see? You ask yourself whether you have a liability in the foreign currency or asset in the foreign currency. So you will say that, well, I have to pay 3 lakh pounds, so I have a liability of 3 lakh pounds, which means I'll have to invest in such a way that I get 3 lakh pounds. I will invest where? In pounds. And what is the rate of interest in pounds? Well, the rate of interest in pounds seems to be 4.5% flat. So 3 lakhs divided by 104.5 into 100 comes to around 2 lakh 87,081 pounds. Now I need to borrow in dollars so that I can invest in pounds. At the spot rate of 2 into 2, I must have borrowed 5 lakh 74,163 dollars. However, on this dollar borrowing, I will have to pay interest at the rate of 5.5% flat, and hence this comes to approximately 6 lakh 5,742. So under the money market, this is 6 lakh 5,742. So if you go to see 5 lakh 88, 6 lakh 5,741 or 42, then is the option contract and no hedging. No hedging would be easy. Well, if I keep it unhedged, I don't have to pay anyone a premium. There are 3 possible rates. Do you know which rate? Well, there are probabilities given. So 1.91 into 25% M plus, 1.95 into 60% M plus, 2.05 into 15% M plus MRC, and hence this comes to a rate of $1.955 per pound. So if I go to see, the average rate comes to 1.955. So we will say that under no hedging, on an average, your payment would be 3 lakh pounds into $1.955 to the pound. In fact, you need not always do this. You can even do the working for each of these possibilities separately. So this is $586,500. Now comes the option question. Now under options, you will first see whether your invoice currency, which is in pounds, is equal to the contract size. Now the problem is the contract size is not given, which means you can assume that you will get adequate contracts to meet your requirements. So your invoice is actually in pounds. However, contract I don't know, but your exercise price is given to you as dollar 1.97 per pound, and hence if it is given per pound, that means the contract must be in pounds, which means if I were to build up a strategy, I will say that what will I do? Well, I'm an importer, I want to buy the pounds, the contract is also in pounds, and hence I will buy the call option. I don't have to worry because the invoice is in pounds and these contracts that you're talking about are also in pounds, per pounds, 1.97 per pound. Maturity, there's just a single contract. Number of contracts, there's no contract size given, and hence you will buy the call option with a strike price of 1.97. Now if you come on the settlement date, there's no unhedged portion because you have covered the entire contract. So for the hedged portion, what will be the cash flow? Well, 1.91, 1.95 and 2.05. Do not take 1.955, that is the average rate. There are three possibilities. If the rate spot at expiry turns out to be 1.91, will the option be exercised? Will you buy it 1.97? When the rate is 1.91, no. Will you buy it 1.97 when the rate is 1.95? No. But will you buy it at 1.97 when the rate is 2.05? Yes. And hence you will take the probability of 0.25, 0.60, and I think this is 0.15, and accordingly you will try to find that what will be the possible cash flows under the different situations. So you will say that the cash outflows over here is going to be 3 lakh pounds into $1.91 to the pound, okay, 3 lakh pounds into $1.95 to the pounds. But in the last case, if the exercise happens, you guys think and tell me, will the cash flow happen at 2.05? No sir, it will happen at 1.97 to the pound because the option will be exercised. But what is the possibility of each of these events happening? Well, the possibilities of each of these events happening are given to you in the probabilities. So this is 3 lakhs into 1.91, 3 lakhs into 1.91 comes to around 5 lakh 73, 3 lakhs into 1.95 comes to 5 lakh 85, and 3 lakhs into 1.97, 5 lakh 91. So these are the three possibilities. You multiplied by the probabilities. 591 has a 15% chance, 585 has a 60% chance, and 573 has a 25% chance. If I total up, this will come to around 5 lakh. Just a second. 573 into 0.25 M plus, 585 into 0.6 M plus, 591 into 0.15 M plus MRC. This is 5 lakh 82,900. So I'll say this is the best. Well, not yet. There is some premium as well. So what is the premium on the call options? We have been told a premium of $0.04. $0.04 per pound. How many pounds? Well, 3 lakh pounds. And as a result, there will be a further 3 lakhs into 0.04 comes to $12,000. But this is $12,000 which you have to pay upfront, whereas all of these other cash flows, 582, 900, 586, 500, 5 lakh 88, 6 lakh 5,000 will happen after 6 months. And hence you will have to do a time value adjustment. Now the problem is there are 4 rates. Remember, you are a US company and hence for you the relevant rate is a US rate. You have nowhere been given that you have surplus funds and hence deposit rate is not to be taken. So if you want to pay this, well, you have to arrange money at 5.5% and hence plus 5.5% if you do is 12,660, and hence your total cost under the option is 12,660 plus 582 900 comes to around 595 560. You compare this 595 960 with keeping it unhedged, and it is advisable to keep it unhedged. This is 595 560. Okay, so this is question number I think 13 or something, 13. Next you go to 14, which is arguably the most complicated question when it comes to options, bid and ask, and a lot of other complicated rates are there. A Limited of UK has imported some chemicals worth USD 364,897. So you are now a UK company and you have imported chemicals. So you are an importer who has to pay dollars. from one of its US suppliers. The amount is payable in 6 months time and the relevant spot and forward rates are, you have been given USD, which means this is per pound. USD, which means this is per pound, which means the base currency is a pound. For the rates given, the base currency is a pound. Now you are a UK company, usually you would love the rate to be quoted on a per dollar basis, but it is quoted per pound. One option is you convert everything into a per dollar and solve. Another option is you keep it as it is and continue. The borrowing rates in the UK and US are 7 and 6 and the deposit rates are 5.5, this is UK, and 4.5, this is US respectively. If nothing is given, this should be percentage per annum. Institute has also taken this to be percentage per annum. Currency options are available, under which one option is for GBP 12,500. You have been clearly given that the options are in pounds. The option premium for an option with a strike price of USD 1.7 per GBP is 0.037 for the call and 0.096 for the put. So again, the challenge over here is to figure out whether you take the call or the put. For a 6 month period, company has 3 choices: forward cover, money market cover, as well as currency options. Which is the most preferable? Well, whichever gives you the lowest cash outflow. Now this is similar to question number 8, that nitrogen question, where you look at the forward cover, you say $364,897. Now which rate should you select? Well, before you select the rate, you see the base. The base is in pounds. As A Limited, what do you want to do? Well, A Limited wants, as an importer, so A Limited wants to buy the dollars. But the problem is, the rates are not quoted per dollar, they are quoted per pounds. Okay, that means if A is buying the dollars, that is A must be selling the pounds. If A is selling the pounds, what is the bank doing? Well, the bank is buying the pounds, and therefore the transaction happens at the pound bid rate. You will never ever make a mistake over here if you follow these rules. If you find them difficult, then you use trial and error. These are the two rates. Take both the rates. You should at least know whether to multiply or divide. Why? Because dollar has to get cancelled. Answer is in pounds, so you have to divide. However, whichever rate gives you the lowest cash outflow, lowest cash inflow, if it's an exporter, or highest cash outflow if it is an importer, should be selected. Here, if we look at conceptually, we say that is a pound bid. Well, this is the pound bid, 1.5617. 1 divided by dollar, 1.5617 to the pound, and hence 364,897 divided by 1.5617, you will get around pound 2,33,654. Just a second, it seems, oh, I've taken the spot rate, I have to take the forward rate, my bad. This is forward cover, so 1.5455. It's still the bid. Sir, why the bid? Well, I want to buy the dollars, but the base currency is a pound. If I am buying the dollars, on one hand I'm buying the dollars, on the other hand I must be paying the pounds, so I will sell the pounds. If I am selling the pounds, the banker is buying the pounds in the forward market at 1.5455. 364,897 divided by 1.5455 comes to around 2,36,103. As you can see, this is your first point. Second is money market. Now, under money market, if you make the chart, we will say that we have a liability in the foreign currency, that is, you have to pay the dollars. That means you will invest in the dollars in such a way that it becomes 364. Invest dollars. If I invest in dollars, what is the rate? Well, the US deposit rate is 4.5 per annum, which means 4.5 divided by 2, approximately 2.25%. So this is 100. This is 2.25, this is 102.25, but this is 3,64,897. 364,897 divided by 102.25 into 100 comes to around 3,56,867. Now this you will arrange by borrowing, but where will you borrow? Well, you will borrow in pounds. How many pounds will you borrow? Well, in such a way that I get $356. So ultimately here as well, my base currency is a pound. I want to buy the dollars so that I can invest. but the base currency is a pound, that is I will sell the pound. If I am selling the pound, the banker is buying the pound, the transaction happens at the 1.5617 rate, 1.5617 rate. So this is 356,890,867 divided by 1.5617 rate, and hence this is 2,28,512. Deposit it, borrow it in the UK. UK borrowing rate is 7%, so 3.5% for 6 months, and hence this comes to 2,36,510 approximately. So over here under the money market, 2,36,510, it is approximately the same, 2,36,510 as the forward contract. The forward is marginally lower, 2,36,103. And then comes the currency option, the most notorious of all of these over here. So first we will compare the invoice. Pay absolute attention, because otherwise this is very difficult to follow. So over here, let us say we take the invoice. So what is the invoice over here? Invoice currency, for example, is the dollar currency, whereas the contract, as you can see, are on a per pound basis. You have even been given the contract size in pounds. So first thing is strategy. We will say we are an importer, usme kya bada baat hai, importer wants to buy, and hence the call option is the natural instinct. However, importer wants to buy what? Your strategy is to buy the dollars. However, the base currency is not the dollars. Your base currency is in pounds. Buying dollars, that is equivalent to selling the pounds. If you want to sell the pounds, that is you will have to go long the put option, not the call option. This is a very common mistake that a student will typically make. Put option with an exercise price of $1.7, if I am not wrong, per pound. Exercise price is $1.7 per pound. Okay. Next you look at maturity. There is just a single maturity, the 6-month contract. Third, you look at the number of contracts. Now this is a challenge. $364,897. This is in dollars. Contract size is in pounds, around 12,500 pounds. You will have to convert this into pounds at 1.7, the strike price. So this is 364,897 divided by 1.7 comes to approximately 2,14,645 divided by 12,500. So if I divide this by 12,500, comes to 17.17. I can't take that. That is, I will take 17 contracts. Now each contract is worth 12,500. So basically what is going to happen is 17 into 12,500, that is pound, 2,12,500. So what will happen is, this is a put option, that is right to sell the pounds. I will pay pound 2,12,500. In return I will get dollars. How many dollars? 2,12,500 at the rate of 1.7. I will get dollars 361,250. Now unlike the last question, I don't have the spot at expiry. So I don't know whether this option will be exercised or not. In the worst case, the maximum payment I'll have to make is 2,12,500 for 361,250. If I don't exercise these options because the spot rate is actually lower, then might as well my cash flow might be lesser. However, my maximum cash outflow for the hedged portion, I would say my hedged portion, that is for $361,250 in pounds, I'm going to pay 2,12,500. But is there some unhedged portion? Well, yes. So in the last question we did not do all of this because there was no unhedged portion. The entire 3 lakh pounds we thought was fully hedged. So the unhedged portion is 364,897 minus 361,250. So if I take the difference over here, probably it comes to dollar. How much is this? 3644 shayad, maybe 3644. Now I don't know which rate to take, so I will take the forward rate. Now I don't know, your actual cash flow will be at the spot rate then, but I don't know the spot rate, so the relevant forward rate can be taken as a proxy. So this is 1.5455 and hence 3644 divided by 1. 5455 will come to, let us say, in pounds 2358. However, what we have missed out still is the premium. Now if I go to see, premium is going to be paid for 12,500 pounds, and for every pound that you transact, what is the premium? For the put option, this is 0.096 USD into dollar, 0.096 USD per pound. So this will give you the premium for one contract, and you have taken 17 such contracts. 12,500 into 0.096 into 17 comes to 20,400 ka premium. Yeah, but this is in dollars. I'll have to arrange this in pounds. At what rate? Well, at the spot rate. So you'll have to divide the spot rate. Which spot rate? Well, the base currency is a pound. I want to buy the dollars to pay the premium. If I want to buy the dollars, the banker will sell the dollars, okay? But the base currency is a pound. So if I want to buy the dollars, that is equivalent to selling the pounds. If I am selling the pounds, the banker is buying the pounds at 1.5617 rate, 1.5617 to the pound, divided by 1.5617, and hence this comes to 13,063 pounds. But this is to be paid today. Now there are four rates. Which rate will you take? Well, your own country, that is UK, borrowing rate. Your own country's borrowing rate is around 7.5% per annum, that is 7% per annum, that is 3.5% for 6 months, and hence this is 13,520 approximately. Time value adjustment ke baad 13,520. So your total cash outflow would be for the hedge portion 2,12,500, for the unhedged portion 2,355, and for the premium effectively 58, let us say. For the premium effectively, you will pay pound 13,520, and hence your total cash outflow maximum 2,12,500, 2,358, 13,520 comes to 228. It's a fairly complicated thing. 378. You compare this with money market and you compare this with forward. This seems to be the lowest, that is 228, and hence considering everything, it is advisable to go with the currency options. But again, you will have to probably work around this 2,28,380. You will have the premium, unhedged portion, hedge portion, and that will give you your final cash outflow. Question 15 is already done. 16, 17, 18 are kind of on miscellaneous concepts. 16 is on transaction and operating exposure. 17 is on nostro and vostro accounts. 18 I think is 18 and 19 are on foreign investment. So we will review that, do all of those 3-4 miscellaneous problems, and then go to the fate of forward section at the end, which is a problematic section for a lot of students as well. So we will first wrap up the miscellaneous section and then go to the fate of forward section. Okay, so fate of forward we will do after this, right at the end. We look at the GDRs, foreign investment return, etc. 2-3 concepts, 3 or 4 sums on that, and then the fate of forwards. So this is a question regarding, let us say, a global depository receipt. So what do you mean by a GDR? A GDR is an instrument where an entity which wants to raise funds from a foreign investor will issue its own shares. However, Indian companies will issue shares in rupees. Foreign investors, retail ones, don't want to invest in rupees. Let's say they want to invest in dollars, but Indian companies will raise shares in rupees. So how do you bypass this? Well, Indian companies will issue shares to a custodian, a depository, someone like JP Morgan, Morgan Stanley, Goldman Sachs, etc., who will keep the shares, and in lieu give something like a token. Like when you go to a temple, you give your shoes and they give you a token. The person who gets the token gets the underlying shoes. In a similar way, they will issue depository receipts, which are kind of against the deposits of shares that are there, and these depository receipts are issued in dollars. And as a result, when you look at the GDR over here will be kind of denominated in dollars. It will be traded between the US investors listed on the US platform. If an investor wants, they can redeem it against the shares, but most of the investors don't go into that territory. They are quite happy trading the GDRs which are listed in the dollars. Companies like Infosys, etc. have American depository receipts. Global depository receipts are for a much more wider audience as well, GDRs. Now GDR have underlying as shares, and hence if the question asks you to calculate the cost of GDR, it is like the cost of equity shares using CAPM, Gordon's formula, whatever it is. So there would be questions, fairly easy ones, we will review that for a GDR. Second, there is something called as foreign investment return. So what happens is there may be a foreign investor who has invested in your country's shares, in which, or an Indian investor who has invested, let us say, in foreign countries shares. So over here my return will be twofold. So if I'm an Indian investor who's investing in, let us say, Nvidia, a US company which is doing really well because of AI, GPUs, etc. If I invest in Nvidia, my sources of returns are twofold. One, if Nvidia stock price goes up. Second, I've invested in dollars, that is dollar goes up, and hence the rate of return for a foreign investor is calculated something like this. You will calculate a foreign investment return as 1 plus the return on the stock into 1 plus or minus, as the case may be, the return on the currencies, let us say the dollars. So over here, let us say Nvidia appreciates by 10%. However, the dollar also appreciates by 5%, and hence my overall return will be 1.1 into 1.05, let us say minus 1. So this is 1.155 if I am not wrong, minus 1, that is 15.5% return. So this is the return that you will earn, let us say, from a foreign investor. Because if I am just an Indian investor who is investing in Indian stocks like Reliance, if Reliance goes up by 10%, that is my return. But if a foreign investor is investing, let us say, in Reliance, their sources of returns are two ways. You are investing, one, in Reliance. Second, you are investing in rupees. So if the rupee strengthens, that is also your source of gain. So this is another formula that you will remember in case you have to solve for a foreign investor return. So we'll look at these two principles and then kind of solve two sums. Again, go back to two other miscellaneous problems, solve two other sums. So if you go to question number 19 and 18, let us say we first go to question number 18. Question number 18, Mr. Mammon, an Indian investor, so we are an Indian investor, invests in a listed bond in the US. So I'm investing in the US bond, okay. If the price of the bond at the beginning of the year is $100 and is 103 at the end of the year, the coupon rate is 3% payable annually unless given otherwise. Coupon is a percentage of face value. If nothing is given, let us say the face value is $100. In which case, your return on the US bond, your return will be 103 minus 100, that is 3 rupees, $3 plus $3 of coupon upon 100. So can I say that is going to be 6%? Okay, but I'm an Indian investor, so the bond appreciates and gives a return, let us say, overall of 6%. Find the return on investment in terms of the home currency if first the USD is flat, which means there's no appreciation on the USD. So the return, let us say, over here would be 1.06 into 1 minus 1, that is equal to 0.06, that is 6%. Second, if the USD appreciates, you are an Indian investor who has invested in the US bond, earned 1.06, also invested in the dollar implicitly, which appreciated by 3%, minus 1. So this is 1.06 into 1.03 minus 1 comes to around 9.18%. If the USD depreciates by 3%, so the bond still gives you a 6% return, but USD depreciates, and hence 1 minus 0.03, that is 0.97. 1.06 into 0.97 minus 1 comes to, let us say, 2.82%. If the Indian rupee appreciates during the year by 5%, now if the Indian rupee appreciates, that is another way of saying that the US dollar depreciates. If rupee is appreciating, the dollar is depreciating. So this is 1.06 into 0.95, and hence 1.06 into 0.95, 1.007 minus 1 will equal to 0.7%. So that's 0.007, that is in percentage, 0.7. Will your answer be different if Mammon invests in bond just before interest is payable? Okay, even if it is before interest is payable, they are going to get the interest. So your return will be 103 minus 100 plus the 3 interest. Your answer will not change. So that is about it in case you look at foreign investment return. Another question, that is question number 19, is on GDR. So Messrs. Raghu is interested in expanding its operations and is planning to install manufacturing plant in the US. It requires $8.82 million, which is net of issue expenses and flotation cost, to fund the proposed project. Okay, so this is the money that you receive, you need. GDRs are proposed to be issued to finance this project, and the estimated flotation cost of the GDR is, let us say, 2%. In which case, we will say that 8.82 is the amount that I need for the project. So if 100 is needed, 2 rupees is the issue expenses, 98 will be in hand. If 98 is equivalent to 8.82, then 100 is equivalent to how much? 8.82 by 98 will come to approximately $9 million. Okay, there is the total issue proceeds. The additional information, expected market price of the share at the time of issue of GDR is 360. Okay, GDR, remember, gives rights on underlying shares, and these shares are worth 360. Each GDR will represent 2 underlying shares. Okay, so a person who is having 1 GDR will have 2 shares, each share is worth 360. The issue shall be priced at a 10% discount to the market price. So that is 360 minus 10% will probably come to 324. Okay, and the expected exchange rate is INR USD 72. INR USD. Over here, INR USD, as you can see over here, this is 72. This seems to be rupees per dollar only. Okay. The dividend is expected to be paid at the rate of 20%, expected to be paid. So that is like D1, and the growth rate is 12%. Okay. You as a financial consultant are required to compute the number of GDRs to be issued and the cost of the GDR. So number of GDRs will be the issue size, which is $9 million, upon the issue price per GDR. So how will you find the issue price per GDR? We will say 1 GDR has 2 shares, and the issue price per share is 360 minus 10%, that is 324, that is 2 shares. So this is 324 into 2, that is 648. However, the GDRs are not going to be issued in rupees, they are going to be issued in dollars. So if I have to price a GDR in dollar, 648 divided by 72 will come to $9, will be the price per GDR, and hence the number of GDRs to be issued is going to be $9 million divided by $9, that is 1 million. Second, what is the cost of GDR? Well, that is the cost of equity. Ideally, I will use CAPM, but CAPM is not possible because RF, RM, beta are not there. Then I will use Gordon's formula. D1, that is, for example, assuming, okay, it is given that the face value is 100 to 20%, D1 is equal to 20, but 20 is per share. Each GDR has 2 shares. So let us say for each GDR, this is going to be 20 into 2, that is equal to 40. Now, each GDR, the issue price is $9. Now, $9 is in dollars into rupees. If I go to see $9 into 72, that comes to 648 rupees. However, 648 rupees I issue, I don't get 648 in hand, minus 2% is the issue proceeds, and hence 635.04. that is the net proceeds. So I will have 40 rupees of dividend on a net proceeds, for example, of 635.04, and then there is a growth rate of 12%. So this is what? 40, you can even do it on a per share basis. I am doing it on a per GDR basis. 40 divided by 635.04 plus 0.12, that comes to, I think, 18.30. 18.30, that is 18.3% is the cost of the GDR. What is your suggestion if the company receives an offer from a US bank willing to provide an equivalent loan at the rate of 12%? So if I need to raise funds, GDR is costing me 18.3%. If a US bank is giving me a 12%, well, I will take the loan from the US bank because it is available at a lower rate. How much can the company save by choosing the option recommended by you? Well, 6.3%, 18.3 minus 12%, that is 6.3% can be saved. Okay, so this is regarding GDR as well as foreign investor return. Now you go to the 2 types of exposures. 3 types of exposure. One is a transaction exposure. This is a gain on a foreign currency transaction. So if you have actually done an import transaction or an export transaction, your actual gain or loss, if the transaction remains unhedged, that is called as a transaction exposure. This is the gain or loss if the transaction remains unhedged. This is your real gain or loss, and ideally would require protection, would require risk reduction, hedging. Second is translation exposure. This is an exposure, let us say on paper, it is an exposure which arises due to translation of rates. Like for example, if you have a branch and its entire trial balance is prepared in dollars, you are an Indian company, you want to consolidate. So for consolidation, you are converting the trial balance into rupees. Ideally, the branch will receive money in dollars, it will use it to pay its suppliers, salaries, expenses in dollars only, and hence there is no real exchange rate gain or loss. It is just a gain or loss on paper. In accounts, you call it as foreign currency translation reserve. And third is the operating exposure. Now this is a little tricky. This is the exposure that arises from operating in a foreign environment. Like usually we believe that the exposure is if your invoice is denominated in the foreign currency. Like if you are selling to a US client and they are going to pay you in dollars, in which case you are worried that if the dollar rate changes, you will kind of suffer a loss, and hence that is a transaction exposure. However, even if you denominate the invoice in rupees, like for example, let us say you are dealing in with US clients, let us say the rate today is 50 rupees per dollar, you are giving them a $20 bill. Now you say no, I will price them at 1000 rupees, end of story. Now what happens is the exchange rate changes. The exchange rate changes, for example, from 50 to let us say 40, or 50 to let us say 60, whatever it is. If the exchange rate changes, for you it does not matter because you are going to receive 1000 rupees only, but the person who is paying it does matter. So earlier he was paying 1000 divided by 50, that is $20. Now if the rate becomes 60, he pays 1000 divided by 60, that is $16.67. That is the price in dollars falls. If the price in dollars falls, that means demand supply tells you that elasticity, depending on the elasticity, the demand will increase. So there will be a change in the demand, and we will see how to do that in a particular sum. So that type of exposure is called as operating exposure, which is a transaction exposure plus or minus the gains or losses due to changes in demand. So this will give you the three exposures: transaction exposure, that is a gain or loss on actual foreign currency transactions. Second is a translation exposure, which arises if you were to translate the financials of a foreign branch into your own currency. And third is the operating exposure, which is the exposure which is arising from the operating in a foreign environment. Okay, so let us review a sum on this to get a better understanding. These are independent concepts. We are doing it in a particular way. Institute over here has made one small change. We will discuss that change, and hence you can decide to do it the way the institute does or what is done over here. So there's one small change that they've done in the May 24 study material over here in this particular problem. So you go to question number 16. Messrs Omega exports air conditioners to Germany by importing all the components from Singapore. Okay, the company is exporting 2400 units at a price of euro 500 per unit. Okay. So this is your export bill. The cost of the imported components is Singapore dollar 800 per unit. The fixed cost and the other variable cost per unit are 1000 and 1500 respectively. So you have been given the entire cost structure. The cash flows in the foreign currencies are due in 6 months, and the current exchange rates, that is a spot rate, are given to you: rupees per euro with the euro base, rupees per Singapore dollar base. After 6 months, the exchange rates turn out to be as follows. So you have been given rupees to euro as well as rupees to the Singapore dollar rates. You are required to calculate the loss or gain due to the transaction exposure. That is about it. So first part is very easy. They could have also asked to calculate the loss or gain if the transactions remain unhedged. Your answers would have been exactly the same. So due to transaction exposure, so let us say if you were to look at the spot transaction, whereas the rates 6 months later, if I look at the sales 500 euros, if I were to do it on a per unit basis, I will receive the euros and hence I will sell the euros, that is the banker will buy the euros. So transaction, if happening, will happen at the bid rate. So this is 500 into 51.5, that is 25,750. Now of the imported component, I have to pay Singapore dollar 800. So if I have to pay, I will buy the Singapore dollars. If I am buying the dollars, banker is selling the dollars at 27.25. So 800 into 27.25 comes to 21,800. Okay, apart from that, fixed cost, variable cost is 1000, 1500. So if I were to find the profit per unit, 25,750 minus 21,800 minus, let us say, you will get, I think, 25,750 minus 21,800 minus, you will get, I think, 1450. So if the exchange rates never change, 1450 would be the profit per unit. There are around 2,400 units, and hence your overall gain should have been 34.8 lakhs. However, the exchange rates actually changed, and 6 months later, for the euros, for every euro you are going to get 52. You will sell the euros, banker will buy, and you will get 52. 500 euros into 52, that is a good 26,000. You are getting more. But on Singapore dollars, you will have to pay more, 27.75. 800 into 27.75 comes to 22,200. Fixed and variable cost remain the same at 1,000, at 1500. And hence, if you go to see, this will be, let us say, I think 1300 will be your gain into 2400, which comes to an overall 31 lakh 20,000, and hence if I take the difference between the two, there is a 3,60,000 loss overall on account of the transaction exposure. Why? Because, well, the euro is changing in your favor, however the Singapore dollar is changing against you, so there may be some gain in the euros, there may be some loss on the Singapore dollars. At the end of the day, you are losing 3,60,000. In this particular case, 34 lakh 80, 31 lakh 20, that is 3,60,000. You can even solve it in some other way. Point 2, based on the following additional information, calculate the loss or gain due to transaction and operating exposure. So this is a new part. If the contracted price of an air conditioner is 25,000 rupees, end of story. So over here we are saying that we are going to transact at 25,000 rupees. So even if the rate changes, we are at 25,000 rupees only. However, Singapore dollars are still, let us say, in Singapore dollars, and the current exchange rate changes to rupees to euro, rupees to the Singapore dollar. So this is the current exchange rate. For some reason it changes to 27.1 and 15. So at today's rate, if I were to buy the Singapore dollars, that is a banker would sell, they would sell at 27.15, and hence this is 27.15 into 800 comes to around 21,720. Apart from that, the same 1,000 and same 1,500 cost, and hence the profit comes to 25 minus, let us say 25 minus 21,720 minus 2,500, and hence the profit is 780. Now, if the rate actually changes the way it does, and this becomes 22,200, then this is 25,000 minus 22,200 minus, so you get only a 300 rupee profit. So if I look at the transaction exposure now on 2,400 units, when I thought I will earn 2,400 into 780 had the rates remain constant, that is 18,72,000, I merely end up earning 300 into 2,400, that comes to around 7,20,000. And hence the difference between the two, if I go to see, the difference between the two is arising due to 1872, it is arising of 11,52,000. It is arising because the exchange rates have changed. You could have calculated it directly because यहाँ पे कुछ euro का लेना देना नहीं है. So 27.15 minus 27.75, that is equal to around 0.6 per Singapore dollars into 800 Singapore dollars per unit into 2,400 such units, that is exactly 11,52,000 overall transaction exposure. Now they say that the price elasticity of demand is 1.5 and payments and receipts are after 6 months. So over here what will happen? Ideally, okay, I will say ideally, the price today, at today's level, the price is how much? Well, I would say rupees 25,000 for the European customer. If he were to go and buy at today's rates, that costs the person 51.75. So ideally at the revised rates, this is 51.75 per euros, and hence 25,000 divided by 51.75 comes to around 483. This must be the price, 0.09. So at the rate after 6 months, this will be 25,000 divided by, I think, 52. And hence this will be, let us say 25,000 divided by 52 comes to around euro 480.77. So the price kind of falls, the price is falling. Now what institute over here has done, they have compared earlier, they have changed the solution in May 24. Earlier they were making this comparison, now they are comparing this with rupees 25,000 divided by what the old rate was, which is 51.5 per euro. So they are saying 25,000 divided by 51.5, which comes to euro 485.43, which now falls to 483. So basically if I find the percentage, either ways this is 0.48% fall, or if I look at the percentage coincidentally, this is a 0.48% fall. This is what the ICI is doing now. In my opinion, you should compare with 483 and 480, but if it comes in the exam, well, institute ki jai ho, and you will probably do what the institute has done, at least in the May 24 study material, and show the change at 0.48% the way ICI has done by comparing the rate at 51.5, which is there today, with 51.75. Ideally, you should compare 51.75 if it is given as current rate with the rate over the 6-month period. Basically, at a concept, there's a fall of 0.48%. If elasticity is 1.5, that means the demand will rise by 0.72%. That is 2,400 into 0.72%, that is equal to 17.28, that is 17 units. For each of the units, how much will be the contribution, we will say that for each of the units this demand will eventually increase, and when it eventually increases, ideally it will impact the profit. Acha, how much will be the profit eventually? 25,200 minus 22,100. Remember, fixed cost ideally will not change, but the variable cost will, and hence we will say that the profit per unit on these 1700 units will be 25,000 I will get, minus eventually 22,200 will be the cost, which is what institute has also taken, minus 1500. Here they have said that it is not a costing paper, it's an AFM paper, and hence whether you subtract the 1000 or you don't subtract the 1000, they have given you both the answers, though this is more accurate. 25 minus 22,200 minus 1500, and hence this comes to 1300. So we are saying that, well, on these 17 units into 1300, there will be a 22,100 gain because you are operating in the foreign environment. Apart from that, there was a 11 lakh 76,000, what was that, 11 lakh 52,000 loss, and hence your overall exposure on operating in the foreign environment is 11 lakh 52,000 loss and a 22,100 gain. So 11 lakh 52,000 loss and a 22,100 gain will give you the operating exposure of operating, and hence this is 11 lakh 29,900. Even if you don't do that and you directly show the working by taking 300 of profit, that will also work. So this is one question where ICAI has made a small change, if I'm not wrong. So instead of doing this, they are comparing this with 51.5, finding this as 485 and saying that the price is falling from 485, which was there earlier, to 483, and hence a 0.48% change. So this is one small change. In my opinion, it is best to compare what it was there earlier, but nevertheless we want to keep our solutions consistent. So this is one place where the institute has possibly made a small change. So this is your overall 11,29,900. Next, there are three types of accounts. There's something called as a Nostro account, Vostro account, and Loro. Nostro account means my account with you. So if I am ICICI Bank in India and I have a dollar account with Citibank in the US, that is called as Nostro account for ICICI Bank. Vostro account is your account with me. Like Citibank will call ICICI's account with it as its Vostro account, whereas Loro account is an account of a bank with a third party. So neither my account nor your account with a third party. So sometimes a question asks you to calculate the balances of the Nostro or the Vostro account. Remember, if it is, for example, if it is, for example, a Nostro or a Vostro account, there are two positions. One is a cash position, one is a exchange position. Cash position is a position which has debit and credits. It is like your actual bank account where in your passbook you show deposits in the credits and withdrawals in the debits. Cash position is exactly your bank account. So if there is actual movement of cash, that is when your cash position will be impacted. However, exchange position is the overall position. Like when you enter into a forward buy, currently there is no cash movement. However, you have taken a position. So your exchange position has two columns, buy and sell. When you enter into a forward buy, you will add that into the buy column. When you enter into a forward sell, obviously you add it into the sell column. However, what if the forward buy is cancelled? Well, that means cash is not going to move. However, you have already added the buy position. To reverse it, you will you will put the effect in the sell column. I'm sorry, or if you had entered into a forward sale and that forward sale is cancelled, in that case, you must have already put the sale into the sale column. If it is cancelled, you will kind of put it in the buy column. Other two adjustments which the institute usually takes is bills, like Citibank in the US might buy a dollar bill. So, or ICICI, let us say, in our example, ICICI is an Indian bank. It has its dollar account with Citibank in the US. A customer comes with a dollar bill. ICICI buys that bill and pays to the Indian customer in rupees. Now, that bill, when it matures, ICICI will get the dollars, and hence when bill is purchased, that does not immediately impact your cash position. However, it will impact your currency position. Remember that when bill is bought, you will add it to the buy column, but when that bill gets cancelled or dishonored, you will adjust it in the sell column. Draft is like a banker's check. When banker writes a check, well, an Indian customer comes and it says, I want to pay someone in the US. So ICICI Bank writes a check from its dollar account. Indian customer pays money to ICICI, they write a dollar check, which means currently till the time the check is encashed or the draft is encashed, it will impact your exchange position in the sell column. But what if the draft gets cancelled? Then you will put it in the buy position. So there is one type of a problem which comes, and it has come multiple times. When I gave the exam, even at that time this same type of problem was there. Even now there is the same type of problem. So over here if you apply that in this particular problem, I think question number 17, a one standard Gisapita type of a problem which will come, maybe numbers are different but ultimate effect will be the same. So let us try to review this in question number 17. You as a dealer in foreign exchange have the following position in Swiss francs on 31st October 2009. So these are the positions in Swiss francs. Balance in the Nostro account. Nostro means my account with you. ICICI says my account with Citibank is a credit balance of 1 lakh. Okay, so this is Nostro account, will show debits and credits. So there will be debits, there will be credits. I can see an opening 1 lakh, cash position balance. Then on the currency or exchange position, the columns are going to be buy and sell columns. Opening position overbought. So your opening overbought is in the buy section. So this is 50,000. Okay, 50,000. Purchased a bill on Zurich. Zurich is Swiss, which means I purchased a Swiss bill. That means till the time the bill is matured, I will not get the francs, but I have an exposure to receive the francs. And hence, will it impact my cash position? No. Currency position? Yes. And as a result, if I am purchasing the bill, for example, in Zurich, I will add this to the buy column. This is 80,000. Next, sold forward TT. This is forward contract. Sold forward sale will impact the sale column, 60,000. Forward purchase contract cancelled. Once upon a time, I must have entered into a forward purchase contract and it must have recorded in my buy. If this forward purchase contract is cancelled, you guys tell me, where will this go? Well, forward purchase would have gone in buy. If it is cancelled, it must go in sale. So this is 30,000 in the sale. Remitted by TT, that is spot remittance of 75,000. Remitted means debited. When money is paid, it's like a passbook. Remember, this will also affect the overall exchange position. Actual money going out, spot will also affect the exchange position. And then draft on Zurich cancelled. When I gave a draft, I agreed to pay Swiss francs. However, the draft got cancelled. When I issued the draft, I must have put it in the sell column. When the draft gets cancelled, I will put this in the buy column. So over here, this is the draft, let us say, getting cancelled. So this comes to, let us say, in the buy column, I think 30,000. And that's about it. What steps would you take if you were to maintain a credit balance of Swiss francs 30,000 in the Nostro account? Now, if I look at my balance, it is 25,000. If I need to make it 30,000, I need to deposit another 5,000 and hence there will be a 5,000 deposit. But when I deposit 5,000 in the spot market, it will also impact my spot deposit, my currency position of 5,000. Okay, and now if I go to see 1,05,000 minus 75, I will have a 30,000 balance. And keep an overbought position of Swiss francs 10,000. Now if I look at my position, this is 60, 30 and 90. So this is 165 on my sell. 50, 80, 30 and 5, again 165 on the buy. So I am not having a buy or a sell position. So I will have to buy 5,000. What? Spot or forward? Well, if I buy spot, it will also impact my cash position and hence I will do a forward buy. I will do a forward buy of 5,000 and thereby it will impact my buy position. So over here, this will be 1,75,000, further 5,000 deposit. Ultimately, that 5,000 deposit will also come over here, and then ultimately you will also have a forward purchase, will not impact the cash position, and that will give you your answer. Okay, so these are these miscellaneous topics. One question on each of these topics: GDR, foreign investment return, operating or transaction exposure, nostro, vostro, loro accounts. After that, you have the fate of forwards, and there is one more problem which is a little annoying as a problem which a lot of students face difficulties in determining the bid and ask rates. That is question number 6. We'll quickly try to discuss question number 6. It's a slightly tricky question, and then go to the last section which involves fate of forward. So we are almost at the end of currencies. So in this question, your London bank's office has a surplus fund to the extent of $5 lakh. Now this is a little strange. Usually if it's a London bank, it should have surplus or money in pounds. Here it is having in dollars. But this is surplus funds of 5 lakhs only for a period of 3 months, and there is a cost to the funds of the bank is at 4%. Now I don't know what this is, but probably you can think of it this way, as if you have given something on rent and as a result you have received a security deposit. So over here you have received a security deposit for a period of 3 months, and hence you have $5 lakh with you for a period of 3 months. Usually deposits are interest free. However, in this case it is negotiated that the deposit is received by you. You can do what you want with that deposit for 3 months. However, when you return it back, you have to return it back with 4% interest. So basically one needs to be very clear of what is happening over here. You currently have a surplus of $5 lakh, but there would be, let us say, a payment due after 3 months of how much? $5 lakh plus 4% per annum into 3 by 12. So this is 5 lakhs into 4% into 3 by 12. That comes to, I think, $5,000. This is what people cannot get their arms around. They say, "There, ye to surplus hai. How can there be a cash outflow?" It is surplus only for 3 months, which means you might keep 5 lakhs as it is. After 3 months, you have to give back 5 lakh plus 4% for a period of 3 months. That is 5 lakh $5,000. Currently, it is surplus for you, but when I receive security deposit, it is like surplus for me. But when I have to give it back, that is kind of a payment. So over here, there is, I have money with me now, but I need to ensure that I get back 5 lakh $5,000 after 3 months. So generally what happens, you are an importer. An importer has to pay 5 lakh $5,000 after 3 months. वैसा दिया रहता था, half the problem would have been solved. Here, instead of giving that, they have told you that there is some surplus, you have some cost. At the end of it, think of it this way, that you have to pay 5 lakh $5,000 after 3 months. You have this money with you right now. It proposes to invest these funds in either London, New York or Frankfurt and obtain the best yield without any exchange rate risk to the bank. So it wants to cover it, hedge it. The following rates of interest are available at the 3 centers for investment of domestic funds for a period of 3 months. London, well, if I invest in London, that is at the rate of pounds. If I invest in New York, the investment will happen in dollars. I have $5 lakh, I invest it in dollars, so that will become $5 lakh plus, I don't need to convert anything, $5 lakh into 8% into 3 by 12. That will give me probably, just a second, 5 lakhs into, that will give me $10,000, and hence I will have $5 lakh $10,000 at the end of 3 months. I need to arrange for a payment of $5 lakh $5,000, which means there will be a 5,000 surplus, but I am a London based entity and hence I will have to convert it to pounds at the appropriate rate. And Frankfurt is 3%. The rates in London for US dollars and the euro are as follows. So these are the rates given to you. The problem in this question is they have not given you any notation. They've just left it as it is. London on New York and London on Frankfurt, and that is about it. They have not given you anything. London on New York means one of them is pound, one of them is dollars, but which of them? Well, between the dollar and pound, which is a stronger currency? Well, for 1 pound, you get more than $1, and hence probably this must be dollar per pound. Similarly, this is London on Frankfurt, between pound and euros, again which is stronger? Well, for 1 pound, you will get more of euros, and hence this seems to be euro per pound. Ideally, it would have been much more better had they given you these rates, but if they have not given, you will have to infer looking at the strength of the rates and give you a solution. Institute has also done that. At which center would the investment be made, and what will be the net gain to the nearest pound on the investment funds? So if I were to invest in US, ultimately my gain will be 5,000 after 3 months, but this 5,000 to the nearest pound I'll have to convert. So I'll say these dollars I'll have to convert back to pounds. So I'll have to look at the dollar and pound rate, the 3-month forward rate. I know 3 months forward. Achha, the rate is 80 and 85, which means it is given in ascending order. So I will have to add, this is dollar 1.5350 plus 0.0080. This is 1.5350 1.5430 to the pound and 1.5390 plus 0.0085 comes to $1.5475 to the pound. So you will say that your base currency is the pound. After 3 months, you have 5,000 surplus dollars. So as the entity, you will want to sell the dollars. That is, you will want to buy the pounds. But if you are buying the pounds, that means the banker is selling the pounds and hence the transaction happens at the pound ask rate. That is 1.4575. Now if dollar has to get cancelled, 1 divided by dollar 1.4575 to the pound, this is 5,000 divided by 1.5475 comes to around 3231 approximately. So at the end of it, I'll have a 3231 gain in case of dollar investment. Now if I look at pounds, today I have 5 lakh dollars with me. I can convert this into pounds today. But today, which rate? Well, over here there are two rates. I want to invest in pounds in London, so I'll have to convert. So I will say that, well, if the base currency is pound, I want to buy the pounds so that I can invest. That is, the banker will want to sell the pounds and hence the transaction happens at the pound ask rate. I'll again repeat, I want to buy the pounds, that is, the banker wants to, I have 5 lakh dollars with me. I want to buy the pounds, that is, banker wants to sell the pounds, banker sells the pounds at the pound ask rate 1.5390. So this is 1.5390. If I divide 5 lakhs divided by 1.5390 comes to 3 lakh 24,886. This you will deposit in the UK at 5% interest. So this is 327 or 324,886 plus 1.25%. So this ultimately comes to around 3 lakh 28,947. Now, do I need to convert everything into dollars? No, I need to convert an amount which is sufficient to pay $5,05,000. So I need $5,05,000. Here, $5,05,000 I need after 3 months. That is, I need to buy the dollars from the pounds. I need to buy the dollars. However, over here, 3 months later, the base currency is still the pound. As a customer, I need to sell the pounds so that I can buy the dollars. That is, the banker will buy the pounds and hence the transaction happens at the pound bid rate. Pound bid rate is 1.5430. 1 upon dollar 1.5430 to the pound and hence 505 upon 1.5430 comes to 327. So out of this 327, 285 will be spent and 328,947 minus 327,285, you are left with around 1662 pounds, which is less than what you have in dollars, which is around 3231. So if I look at this, in my pounds 1662, in my dollars 3231. Now comes the last case, which is the euro case. Now the problem is I don't have the direct rate between pound and euros, which means I'll have to use dollar as the intermediate currency. So I'll have to figure out which rate to take. So over here, currently I'm starting with what? Well, I'm starting with 5 lakh dollars. I don't have, I mean, you can directly find the cross rate, but just for reference, I'm starting, let us say, with 5 lakh dollars. Ultimately, on this 5 lakh dollars, I'll have to pay 5,05,000 at the end. So 5 lakh dollars, I will convert this into pounds. From pounds, I will convert this into euros and then deposit. That is basically taking the cross rate. So over here, if I go to pounds, I've already found that 5 lakh dollars I will convert into, if you go to see over here, in pounds, 1.539, that is 324,886. 324,886. But I cannot invest it today directly in pounds. I want to invest it in euro. So over here, again for euro, the base currency is the pound. As a customer, what do you want to do? Well, you will have to sell the pound so that you can buy the euro and hence the banker will buy the pound and hence the transaction happens at the euro to pound bid rate 1.8260. Euro 1.8260 to the pound. So over here, well, 324,886 into 1.8260, this comes to euro 5 lakh. 593,242. Now you will deposit it in euro at the rate of 3% per annum, on which you will earn some interest, and hence this will become around euro 5,97,691. What will I do? Well, I'll have to again take it back. Well, I'll take it back to pounds, and then from pounds I will take it to dollars. But do I need to convert everything? No. So what I will say is, well, currently also 3 months forward, the base currency is the euro. Sorry, the base currency is the pound. As a customer, you want to sell the euro, that is, you want to buy the pound. Basically, if you want to buy the pound, the bank will do what? The bank will sell the pound, and hence the transaction happens at the pound ask. Now the problem is the forward rate is not given. However, 145 and 140 descending order. So you will deduct 0.0145, 0.0140, 1.8260 minus 0.0145 comes to euro 1.8115 to the pound, and 1.8290 minus 0.014 comes to euro 1.815 to the pound, and as a result, if it is happening at the pound ask rate, this is euro 1.815 to the pound. So this is 597,691 divided by 1.815 comes to, in pounds, 3,29,306. Do I need to convert everything into euros? No, only that much, which is sufficient to pay $5,05,000, and that much we have earlier calculated was around 3,27,000. We have already calculated 3,27,285. It's a fairly complicated question. I believe that mastering the bid and ask over here is a little problematic, but the conclusion that you get over here, that is a pound 2021 surplus. If you had converted directly from euros to the dollars, you will have some surplus dollars which you will have to again bring it back to pounds, because the answer has to be kept in pounds. So over here, if the surplus is deposited in the US, I'll earn around 3,200, in the UK around 1,662, and in the Europe we will have 2021, and hence we will try to invest in US where we get the highest return. So this is a bit of a complication, and with that, probably this question, which has a lot of bid and ask, forward, swap points, also kind of goes behind you. So the last part of this chapter involves fate of forwards. When you look at fate of forwards, there are 4 actions that you have to be careful about. The first action will be cancellation. So how do you cancel in case of a forward contract? You cancel it by taking the opposite position, which means if you have originally taken a forward buy contract on 1st of January for $1,000 at the rate of rupees 50 per dollar, and now this is for 3 months. Now 2 months later, you don't want this position, so there's 1 month still remaining. So this is not a tradable contract. So how will you cancel it? Well, for the purpose of cancellation, you will have to take an opposite position. So for the purpose of this is your original contract. So on 1st of March, that is 2 months later, you will enter into a forward sale, that is the opposite position. Originally buy, so this is sell for the remaining 1 month. So that on 31st March, when you are going to buy these dollars at 50, there's another contract where you can hand over those dollars, and hence the position will be settled. At what rate? Well, whatever is the prevailing rate, let's say at 52 per dollar. In which case, you will calculate the gain or loss on cancellation as the buy price and the sale price. So selling price minus the cost price. If I do SP minus CP, that is 52 minus 50 into $1,000, that is equal to 2,000 rupees. But this gain, remember, will happen on 31st March. It is not happening immediately, it will happen on 31st March. Okay, so this is cancellation if it is done before maturity. However, is it possible cancellation is done on the maturity date? So over here, this is happening on 31st March itself, in which case you are on the maturity date, in which case you will again, a buy contract will be cancelled by selling, so you will take the opposite position, that is sell. However, there is no remaining balance unexpired period, and hence you will cancel it by the spot selling. So there will be a spot sale at the rate of 52, and the same process will apply. So this is regarding cancellation before or at maturity. Second is extension. So when you look at extension, extension means cancelling the existing contract and entering into a new contract. Like in this case, you wanted on 1st March a delivery, not on 31st March. Now you want a delivery on, let's say, 30th April, in which case you will have to cancel the existing contract by taking the reverse forward and enter into a new contract for the new period. So over here, this is regarding cancellation and extension. There is one interesting question that kind of covers both. So we will try to go to question number, I think, 9. It's a decent question on extension. So you will have cancellation, extension both done over here with a fair degree of complexity as well. So an importer requests his bank to extend the forward contract for $20,000 which is due for maturity on 30th October. So I'm an importer and I'm requesting my bank to extend the forward contract of $20,000 which is due on 30th October for a further period of 3 months. Okay, he agrees to pay the required margin money, that is the cost for such extension. So the margin money will be applied on what? On the extension, and extension is a sum total of cancellation plus the new contract. So both on the cancellation rate as well as on the new contract rate, there will be some margin money applicable. Contracted rate over here is 42.32 per dollar. The US dollar is quoted on 30th March. So today you are sitting when? Tell me, are you sitting on maturity or are you sitting before maturity? So you are sitting on maturity. 30th October, the rate is given to you spot rate, and a 3-month premium, flat premium of 0.87% and 0.93% is given. This is given in the ascending order, and hence you will add to find the forward rates. So basically 41.5 plus 0.87% will come to, let us say for understanding, 41.8611 and 41.52 plus 0.93% comes to 41.9061. So these are your 3-month forward rates. Margin money for the buying and selling rate is 0.075% and 0.2% respectively, but they have not told you buying and selling rate for whom. Well, remember, margin money is quoted by the banker, and this is buying and selling rate from the bank's perspective. So we have to figure out that the cancellation rate or the new contract rate is a buying rate for the bank or is it the selling rate for the bank. You are required to find the cost to the importer in respect of extension of the contract. So that is a gain or loss on cancellation, and also the rate of the new forward contract. So how do you do or address such problems? Well, you look at question number 9. First, you will look at the original position. So what is my original position? I will say my original position was a forward buy because I'm an importer. I'm doing evaluation from the customer's perspective. Forward buy because I'm an importer of $20,000 at the contracted rate of rupees 42.32 per dollar. This is given to you. This is the originally contracted rate. No adjustment to be done over here. Now, if there is an extension, there needs to be a cancellation. Now, cancellation is happening on 30th October, which is on the due date, which means the cancellation happens by a spot. What? Sell of what? $20,000 at a particular rate. Sir, which rate? Rupees per dollar rate. Sir, which rupees per dollar rate? Well, if you want to spot sell, that means if the base currency is a dollar, as a customer, if you want to spot sell, you want to sell the dollars, that means a banker over here is going to buy the dollars. If the banker buys the dollars, banker buys the dollar at what rate? Well, at the dollar bid rate. Do I have the bid rate given to me in the question? Yes, sir. The bid rate is given as 41.5. But that is a banker's buying rate. We are agreeing to pay margin money. Margin money over here is 0.075% on the buying rate and 0.2% on the selling rate. So over here, my cancellation rate will be the spot sell rate for the customer, that is the spot buy rate for the banker, which is rupees 41.5. On this margin money, which is fine, most people will get this at 0.075%. 41.5 into 0.075% comes to rupees 0.0311 per dollar. The problem is, will you add or subtract? Well, remember, margin money is a cost. It will increase your cost price or reduce your selling price. Over here, if it was original contract is a forward buy contract, this is 42.32 by cost price, whereas whatever you get over here is selling price. So what do you guys think? If margin money is like a cost, will it increase my selling price or reduce my selling price? Sir, it will reduce my selling price, and hence I will deduct 41.5 minus 0.0311 comes to rupees 41.4689 per dollar. This is your net selling price. So if I want to find a gain or loss on cancellation, this is 41.4689 to the dollar minus 42 0.32 to the dollar into, for example, if I multiply, this will be multiplied, for example, with how many dollars? Well, this will be multiplied by $20,000, and hence 41.4689 minus 42.32 into 20,000 will be around 17,022. This is a loss for the customer, so they will have to pay to the bank. If there was a gain, they could have recovered from the bank. Next, you look at the new forward contract. Now, the new forward contract, originally as an importer, you wanted to buy, you still want to buy, and hence you will enter into a forward buy contract. If you are buying, the banker is selling. The banker will sell at what rate? 41.9061. So your relevant rate would be 41.9061 per dollar. This is forward buy for the customer, but that is a forward sale. Let us say for the banker, we say, sir, how does it matter? Well, it matters because we are agreeing to pay margin money, and margin money on the selling rate is 0.2%. So this is 0.2% of 41.9061 into 0.2% comes to 0.0838 to the dollar. So this is 41.9061 plus 0.9061 plus 0.0838. Sir, why plus? Well, because I am buying, and hence if there's a margin money, it will increase my cost. It increases my cost price, it reduces my selling price, and hence the relevant new forward rate will be 41.9899. So this is regarding extension, a little complicated. How did we start? We said that the original contract was a forward buy contract. You don't need it anymore, and hence you take the opposite position, that is sell position. Secondly, when you took the sell position, you were selling, but at the same time banker was buying. We agreed to pay the margin money, and hence on that rate of 41.5, we said margin money at the rate of 0.075% will be adjusted. Adjusted bole to, well, if it is selling price, it will reduce the selling price, and hence we subtracted. However, in the new forward case, you want to forward buy, banker will sell, and hence you took the 0.2% rate. However, this is your cost price, and margin money will increase your cost price, and hence we add this. So this is regarding cancellation and extension. And then going into the last two fate of forwards, which are a little problematic. Over here, if you understood it earlier, well and good. Otherwise, you need to kind of get a hang of this, and you remember a few steps. One is for early delivery, second is for late cancellation or automatic cancellation. First, you do early delivery. What you do for early delivery can also be used as a base for the purpose of late or automatic cancellation. Let us say what happens in case of early delivery. This is governed by FEDI rules, Foreign Exchange Dealers Association of India rules, and hence what we are going to do is as per what FEDI rules have recommended. Now, why we do it, for what reason we do it, at this stage we are not going into that. We are kind of first getting the process, steps, the numbers correct. These evaluations, only and only these two evaluations, that is the early delivery and a large part of the late cancellation or automatic cancellation adjustment, we are going to do from the banker's perspective. So how do we do that? Well, we think from the banker's perspective. In case of an early delivery, we think that what is the banker going to do? Like, for example, if I am an importer and the importer wants an early delivery, so the banker says that I had agreed that I will give you the dollars on 31st March, you are coming on 20th February, you want the dollars at the agreed rate. Okay, I will give you the dollars, you will give me the rupees. But from where will I arrange the dollars? So because the customer is coming early and the bank has to take additional actions, these are called as swap cost. So the customer comes early, and we will do it with the sum only, with the numerical, so that you understand, because otherwise it is very complicated. So over here, the customer comes early. Step number one, we will say in point number one, what will be the cash movement at the agreed forward rate, because the customer comes early. We have agreed to pay him at the rate of 50 per dollar. So I will give him $1,000, let us say, which was agreed at 50 rupees per dollar. The customer gives me 50,000 rupees. That is a cash inflow, and I will give $1,000 as agreed to the customer. That is point one. Point two, I will say that if I have to give $1,000 to the customer, I will have to buy it. From where will I buy it? In the spot market. I will go to the interbank market and I will spot buy the dollars. In which case, if I am buying the dollars which I have to give to the customer, I will have to pay in the interbank market rupees, which is step number two, the payment under the rupee. Let us say position spot buy for $1,000. Remember, swap means if you are spot buying, forward may you are selling. Sir, what is the logic for forward sale? FedI believes that banker must have entered into an offsetting contract on 1st January when they did a deal with you to give you $1,000. They must have done some other deal from which they were going to buy the dollars. Now you came early and hence you settled the contract early, but the banker still has to honor the original deal, which was a forward buy deal. But it does not need that anymore, and hence to cancel it, they will do a forward sale. If you understand that, well and good. Otherwise, point 3 will be, if there was a spot buy, there will be an opposite, that is a forward sale. Now this is called as a swap. FedI says you will calculate 3 steps. Step number 1, you will calculate point number 1, original forward contract at the agreed forward rate, point 1. Point 2, spot transaction at the prevailing spot rate. Point 3, opposite forward transaction at the prevailing forward rate. The difference between 2 and 3 will be called as the swap cost. If there is a gain, you will hand over the gain to the customer due to the additional actions. If there is a loss, you will recover the loss from the customer. However, all of these are happening, let us say, a month early, and hence there should be some time value adjustment, but time value adjustment is only on actual cash movements. Actual cash movements happen in step 1, that is agreed forward, and in step 2, where you are going to the spot market and buying. When you enter into a forward buy or a forward sale, that is just a position taken, and hence the difference between 1 and 2, if it's an outflow into the interest rate, you will charge from the customer. If it's an inflow into the interest rate, you will pay to the customer. It is a little complicated. Again, you will probably need a separate session to understand this at length. However, from a pure revision perspective and an exam solving perspective, how do we do it? I will first try to prepare a chart. In that chart, we will do that along with the sum so that you understand money coming in, money going out, forward. We will do all of that. Once we do that, then you will have 3 steps. Point number 1, at agreed forward. Point number 2, spot transaction. Point number 3, the forward, offsetting forward that you will take. 2 and 3 ka difference into the rate will give you the swap cost. 1 and 2 ka difference into the interest rate into the number of days divided by 365 will give you the interest adjustment. That is going to be the amount recovered or paid to the customer. So we will try to do this along with question number 10 so that you get a slight better understanding of the application of these steps. And if you understand this better, the late cancellation part, at least half of that can be better managed. So let us review question number 10. On 1st October 2019, Mr. X, who is an exporter, enters into a forward contract with BNP Bank to sell, that's right, exporter sells $1 lakh on 31st December 19. So this must be original forward sale contract entered by the customer for a 3-month period at 70.4. So this is the selling price for the customer, and the bank simultaneously entered into a cover deal at 70.6. So over here, maybe to calculate bank's profit or loss, this might help. However, due to the request of the importer, Mr. X received the amount on 20th November and Mr. X requested the bank to take delivery of the remittance on 30th November. So that is a month before. That is a month before 31st December. That is before the due date. This is early delivery, not extension, not cancellation, early delivery. You are honoring, you are not cancelling the contract. You are saying that, well, I was an exporter, I was going to give you $1 lakh, you were going to give me 70.4, rather than giving it to me on 31st of December, I will give you the $1 lakh on 30th November, you give me whatever is the agreed amount on 30th November. Okay. The interbanking rates ideally on 30th November, just make it 30th November, were as follows. You have the spotted and 1 month swap points. These are given in descending order, so you will deduct 70 point, I think 07 to the dollar and 70.17 to the dollar. Descending, so you will deduct. If the bank agrees to take early delivery, then determine the net inflow to Mr. X, assuming that the prevailing prime lending rate is 10% and deposit rate is 5%. Okay. While exchange rate should be considered up to 2 decimal points, amount to be rounded off to rupees, no paisa should be required, assume 365 days in a year, so the calculation will be done in days. So over here, the first step is, because you are doing it as per FedI rules, you will evaluate from BNP Bank's perspective. As an exporter was going to give you the $1 lakh and you had originally agreed in step number 1. Tell me, at what rate were you going to give? 70.4 to the dollar. This is the agreed rate. Now, instead of coming on 31st December, the customer came to you on 30th November and you agreed to honor the deal. Okay. So what will you do with this $1 lakh? Well, you will go to the spot market and you will sell it. This is on 30th November only. You will do a spot sale of $1 lakh in return. So if you are selling and you are going to the interbank market, so you are like a customer. If you as BNP Bank are selling, that means the dealer is buying, and hence the dealer buys at the bid rate. So this is rupees 70.22, which is I think the bid rate. I'll again repeat. You will get the $1 lakh. You will sell that $1 lakh immediately in the spot market and get, if you are selling, the dealer is buying, that is at 70.22. However, once you do that, the cover transaction which was originally there, you had entered into an original forward sale contract probably. Why? Because you would have received $1 lakh. To sell that, you must have entered a cover deal at 70.6. We don't care about that, but you would have entered a forward sale transaction. You don't need this anymore, and hence you will cancel it. Sir, how will we cancel it? Well, by doing a forward buy. You don't even need to think all of this. As a general rule, if this is a spot sale, this will always be a forward buy. Now, if you are doing a forward buy, this is an additional action that you are taking because the customer came early. Point 2, this is an additional action because the customer came early. This is an additional action that you are taking because the customer came early. This is a forward buy at rupees. Okay, if you are buying, the banker is selling, that is at 70.17. Rupees 70.17 per dollar. So these are the three things. So if I have to do the working, point 1, I will say this is $1 lakh into rupees 70.4 per dollar, which is rupees 70 lakh 40. This is a cash outflow for the bank. It is actually going to pay 70 lakh 40. In return, it will get $1 lakh. Yes. Point 2, against that $1 lakh at the rate of 70.22. This is going to be a cash inflow for the bank. 70.22. This is rupees 70.22. This will be a cash inflow. Basically, this is a spot buy additional action. And point 3, $1 lakh into rupees 70.17 to the dollar. Over here, this is rupees 70.17. Basically, there is no cash inflow, there is no cash outflow for this. However, this is a forward sale. Now, what will we do? Swap cost. That is what FedI rules say. Swap cost is the difference between 2 and 3. Acha, 2 is a spot buy, 3 is a forward sale. So gain or loss will be a forward sale, that is a selling price of rupees 70.17 lakhs minus spot buy, which is like the cost price. Spot buy, which is rupees 70.22. And as a result, there is a loss of 70 lakh 17,000 minus 70 lakh 22,000. That is a 5,000 loss, if I am not wrong. There is a 5,000 rupee loss. This is a swap cost. There is a loss that the bank will recover. Bank had to take additional actions, and those additional actions resulted in the bank having to incur a loss of 5,000. This is because of the customers coming early, and hence 5,000 can legally be recovered from the customer. Second is the interest adjustment. Interest adjustment is the difference between 1 and 2. Acha, 1 is a cash outflow, 2 is a cash inflow. So over here there is rupees 70.4, which is a cash outflow, minus rupees 70.22, which is a cash inflow, and hence there is, for example, if I take the difference, I think this is 0.18 into, acha, this is a net cash outflow. If it is a net cash outflow for the bank, that is, it will have to arrange. देखो 70.4 देने के लिए 70.22 तो मेरे को मिल गया, but remaining 18 I will have to arrange, and hence that is at the borrowing rate of 10% into 10%. For simplicity, let us say into 30 by 365. So this is 18,000 into 10% into 30 by 365 comes to around 149.94, or let's say around 150. And hence the total cost to be recovered from the customer will be 5,000 plus 150, that is 5150. Ideally, FedI does all of this to ensure that the banker is not kind of worse off or even better off merely because the customer came early. So this will ultimately ensure that the banker gets a fair deal. So this is around, just a second, 5,000 is to be paid to the customer. $7 lakh forward sale is at what value? Just a second. Have I identified the sell and buy correctly? I've identified it correctly. I've written it wrongly, I think. No, this is a forward buy at 70.17 and a spot sale. मैंने उल्टा लिख लिया. Spot में there is a sale. We have written over here sale. I've by mistake written it wrong. So there is a spot sale. And forward में there is not a sale. There is actually a buy. Sir, how did we know whether there was? Yeah, $1 lakh came in, $1 lakh went out. So there was a spot sale. And opposite of that, there will be a forward buy always. So over here, this is a forward buy and a spot sale. So basically this is, I think this will be sale, means this is a selling price. ऊपर जो है that is like a cost price, and hence 5,000 का अपने को gain आ गया. And there's a 150 cost, so this is 5,000 of gain which is to be handed over to the customer, and 150 of cost to be recovered from the customer, which is approximately 4850. Okay, so this is regarding early delivery. Early delivery is still manageable. Next concept is rule 6 of FedI rules, which is automatic or late cancellation. Over here, what will happen is, as per FedI rules, FedI says that ideally if the customer does a no-show, so if on the date of maturity, the customer should either come take the delivery or cancel the contract. If the customer does a no-show, then the banker is under undue stress, and hence it imposes penal provisions. It says that, well, this will be treated as an automatic cancellation of the contract, and the gain or loss on cancellation will be calculated as the offsetting rate minus the original rate. Whatever the difference is, you will calculate the gain or loss. But on which date will you take? Well, the date when the customer comes. But when will the customer come? Well, the customer can come on the due date, but he did not come. So after the due date, day 1, day 2, day 3, maximum 3 days ka time milega. If the customer does not come within a period of 3 days, then the contract final cancellation rate will be taken as a rate which is the 3rd day from the date of cancellation. So over here, when you do automatic cancellation, the contract will automatically be cancelled. But usually when you calculate the gain or loss on cancellation, you calculate the gain or loss. Let's say you are an importer, you were entered into a contract which was a forward buy contract. Like question 9, you came on 30th October, you said I want extension. You came, you did not do a no-show. Had you stopped receiving bankers' calls, then on 30th October, the contract will be automatically cancelled. However, which rate will you take? You will take the 30th October rate in general? No. As per FedI rules, you will look at the next 3 days, 1st, 2nd, 3rd October. If the customer comes on any of those days, the date when the customer comes will be the relevant rate. However, if the customer does not come even by 3rd October, then the rate on 3rd October will be taken as, not 3rd October, 3rd November. 1st November, 2nd November, 3rd November. The rate on 3rd November, typically your AFM exam dates, the rate on 3rd November will be taken as your relevant rate for the purpose of calculating the gain or loss on cancellation. Similarly, in that extension sum, there was a margin money adjustment. Here also, if you have agreed to a margin money, then the margin money will be adjusted in this cancellation rate like you did in that extension sum. But is that it? No, the banker might have to take some additional actions because the customer did not come, and hence the customer will have to pay banker for those additional actions as well. That is swap cost as well as interest. So when there is an automatic cancellation as opposed to early delivery, there will be 3 items. There will be something called as an exchange difference, that is the gain or loss on cancellation. Apart from that, there will be a standard swap cost, there will be a standard interest adjustment, and the total of all of these 3 will be recovered from the customer. However, if there's a gain, nothing will be passed on to the customer. When you look at normal cancellation, when you look at normal extension, when you look at early delivery, if there's a gain, you pass the gain on to the customer. If there's a loss, you recover it from the customer. But here, the FedI comes with the penal provisions. They say that if there is a gain, I will not pass it to the customer. But if there's a loss, I will recover it from the customer. How will that be calculated? As a sum total of 3 adjustments. First is exchange difference, that is gain or loss on cancellation. Sir, we did not do exchange difference in case of early delivery because there was no cancellation. You honored the contract, just that you honored it early, there was no cancellation. Here, there is an automatic cancellation, so that is point 1. Apart from that, the banker will have to take some additional actions, which is called as a swap cost, which you calculate common sense. You will say, okay, this is coming in, this is going out. You do some workings, and then there would be interest. So we will try to do that. There is a lot of theory, but these sums you best understand with a numerical. Again, if you look at this It's a fairly complicated thing. If you understand this well and good, otherwise just remember the steps and proceed. Okay, don't rack your brains and don't leave this without fail, because this comes in the exam, and if it comes, you follow it methodologically and you are kind of sorted. So this is question number 11, probably the last question on foreign exchange. An importer, sir, in any case we have also reached our capacity. Okay, importer, pause the video, take a rest and then come to this question if you have feeling saturated. An importer booked a forward contract. नहीं sir, हम continue कर लेंगे, we will not come back again. चलो, we'll come back to the question. Focusing. An importer booked a forward contract with his bank on 10th of April for USD 2 lakh due on 10th of June at 64.4. So this is my original contract for a period of 2 months. The bank covered its position in the market at 64.28. Okay, covered its position, maybe the importer के लिए importer took a forward buy, so banker agreed to sell originally, but sell करने के लिए डॉलर कहां से आएगा? Probably they arranged the dollars using a cover transaction. Exchange rates for the dollar in the interbank market on 10th June and 13th June are given to you. So this is 10 June rates, these are 13 June rates. You have been given in almost all of these questions rates like this. Spot is the rate prevailing on that particular date. Spot June is like the forward rate at the end of the June. Spot July is like the forward rate at the end of July. Spot August at the end of August. Spot September at the end of September. Exchange margin is 0.1%. Remember, exchange margin is only applied. It is only applied on the rates which are between the customer and the bank. Customer and the bank cancellation rate. If there is any extension or execution, that rate. Remember, swap cost or offsetting forward, all of these are not with the customer, they are with the interbank market. So in this case, if let's say there was a margin money, then it will be only on the rate with the customer. Well, this is not with the customer. This is also not with the customer. It is in the interbank market. We will apply that. Okay. And interest on outlay of funds is 12%. The importer requests on 30th June for extension of the contract with due date being on 10th of August. Okay. Rates are rounded off to 4 decimal multiples of 0.025. For the timing, let us ignore this. If it is given, you could have also considered, but for the timing, forget the rounding off, at least get the answers in order. On 10 June, bank swaps by selling spot and buying 1 month forward. They give you this. I am saying that this is spoon feeding done. Even if it was not done, how do you structure it and figure out what must have happened? We will review that. You are required to calculate the cancellation rate, amount payable on $2 lakh, swap loss, interest on outlay of funds, new contract rate and total cost. Okay. There's a lot of literature. What do you need to do? If you want, pause and read the question again. What is the original contract? The original contract was a forward buy contract for, I think, how many dollars? $2 lakh. This is from the customer's perspective, and the customer had agreed to pay 64.4 probably to the dollar. This is like the cost price for the customer. Now, when was this contract maturing? This was maturing on 10th of June. The customer did not come on 10 June. He did not even come on 11 June, 12 June. He came on 13 June. So, cancellation happens by taking the opposite position. If it was a buy contract, you will cancel it by selling. But spot sell on which date? Sir, this will be 13th June date. 13th June. If the customer came on 10 June, we would have taken the 10 June. All of these would not come. Cancellation is happening on the due date. Customer did not come. He came on 11 June. Then, okay, we would have taken 11 June rate, 12 June. We would have taken 12 June rate, 13 June. We took the 13 June rate. But if he comes on 14, 15, 16, 17, 18, whatever other date after 13 June, the contract will automatically be stood as cancelled based on the rate on 13th June. And the banker will have a legal right to recover that money from the customer through a lawsuit as well. Spot sell based on 13 June rate for $20,000 at what rate? Yeah, I don't know, whatever this rate, this will be the selling price for the customer. We will do this evaluation from the customer's perspective. Selling price for the customer. So you will try to find the cancellation rate. Now, cancellation rate is on 13th June. If the base currency is the dollar, you as a customer want to sell the dollar, that is a banker would want to buy the dollars, and hence the transaction will happen at rupee to the dollar bid rate 63.68. I think this is the rate that you will look at, the 13 June 63.68 rate. Even if the customer came after 13 June, this will be the rate 63.68 which will get locked. Now ideally we could have taken this, however there is a margin money. Now the problem is margin money or exchange margin, should it be applied over here? Yes, this is a rate between the bank and the customer, and hence margin money will be applied like it was applied even in question number 9. So over here you will take the margin money at the rate of 0.1%. So you can find this quite easily. 63.68 into 0.1% comes to 0.063. 0.063, I think 7 per dollar. The problem is, will I add or subtract? Again, pause, think. This is a transaction cost. It will increase my cost price if it is cost, or it will decrease my selling price if it is selling price. Well, cancellation is happening through spot sell, and hence ideally you guys tell me, should I increase or decrease? Say decrease. It will decrease my selling price, and then 63.68 minus 0.0637, for example, comes to net selling price at rupees 63.6163 to the dollar. Now if I want to find a gain or loss to the customer on cancellation, remember, if there's a gain you will not pass on this gain to the customer, but if there's a loss you will recover. This is called as exchange margin, or also called as exchange difference. This is selling price, rupees 63.6163. If you had to round it off to the nearest 0.0025, this will be 63.6175 minus rupees 64.40, which is the cost price, into $2 lakh. If I multiply this, minus 64.4 negative into $2 lakh comes to 1,56,740. This is loss to the customer, hence the banker will recover it. So this will be 63.6163. I think this will be 1,56,740 amount payable. Then there is swap loss. Now how is there a swap loss? Question is very clearly given, so life is easy, but we don't want the life to be easy. So if I look at the bank's perspective, ideally to the importer, bank thought that they will pay $2 lakh and in return they will get some rupees, but this transaction never happened. However, bank has some reputation in the interbank market, and as a result the bank on this $2 lakh, bank will receive this $2 lakh in the interbank market. This was a cover deal, and bank will pay 64.28. It has some reputation to manage, and hence the banker will have to pay this 64.28 in the interbank market. Is this a cash outflow? Yes. So this is your step number 1. Acha, yahan pe early delivery, normal delivery, this did not happen only. This was supposed to happen at 64.4. Nothing happened at 64.4 per dollar. And hence we say that we will have to pay in point number 1. This is my actual cash outflow. But is this the additional action that the banker had to take? No. Even if the customer had come, still the $2 lakh I would have taken as delivery in my cover deal, and I would have paid 64.28. So I cannot say this is an additional action that I had to take. This I would have taken in any case. However, now what do I do with these dollars? Well, I have no use, and hence I will do a spot sale. So this is $2 lakh. I will do a spot sale of these $2 lakh, and in return I will get some money. Acha, when will I do the sale? Sir, on 10th of June, not on 13th. Because I have to honor this cover deal on 10th of June. So on 10th of June, I will do the spot sale, and hence if I am selling, the dealer is buying, and hence the deal on 10th of June happens at the dollar bid rate. Over here, this is 63.8 probably. Again, if I am selling, the banker or the dealer on the other side is buying. So this is 63.8. The question arises that will I adjust the exchange margin over here? The answer is no. This is between you and an interbank dealer. There is no exchange margin adjustment happening over here. This is your point 2. However, as per FedI rules, there is a 3-day period which is there, and hence for the 3-day period, if the customer comes and if he wants the contract, then the bank will have to do that. So you will enter into a forward buy for the nearest maturity. The nearest maturity as given over here is the June maturity. So you will do a forward buy over here. So this is basically for a swap. Remember, if this is spot sale, hamesha forward mein buy hi aayega. You don't have to bother. So this is forward buy of how much? $2 lakh. Now a lot of students say, why should the bank buy? Can't they hold the money? What is the use of all of this? Remember, this is as per FedI rules, and hence you should do it the way FedI rules have recommended. I have not formulated the rules. ICI has also not formulated the rules. This is as per FedI rules, and hence you have to do this. Whether the bank actually does it, does not do it, is beyond our scope. But if you have to calculate the charges, this is how the charges are going to be calculated. Again, you will enter into a forward buy for the nearest maturity, that is a June maturity, on 10th of June, but that is a forward buy. If you are buying, the banker is selling. The banker will sell at what rate? Well, 63.95. So the banker is going to sell at rupees 63.95 to the dollars. This is 0.3. However, will you adjust the exchange margin? Answer is no. Even over here, you will not adjust the exchange margin, because this is not an interbank. This is not a transaction between you and the customer. It is an interbank deal. So 0.2 and 0.3 are the additional actions that I have to take because the customer did a no-show on 10th of June. And hence I can recover the swap cost. What is swap? Sir, swap is given to me by selling spot, buying 1 month forward. Acha, selling spot, buying 1 month forward. Even if that line was not printed, you should be able to do this. Sir, so what do I have to do? Well, honestly, once I find the exchange difference for swap cost, I will do exactly the same workings as I did for my early delivery workings. That is at, I think, $2 lakh into rupees 64.28. This is my cash outflow. At my cover deal, I would have done this even if the transaction was there. So this was 128.56. This is like cash outflow. This is not additional action. Second, 2 lakhs into rupees 63.8 per dollar. 63.8 into 2 lakhs. This is rupees 127.6. This is my rupee cash inflow. Okay. However, I'm also spot selling. So this is my spot sale as well. And then 0.3, 2 lakh into rupees 63.95. Over here, this is 2 lakhs into 63.95 comes to rupees 127.9. There is no cash flow over here. However, there is a forward buy over here. And hence, if I look at these exact same workings for spot swap cost, the difference between 2 and 3, selling price minus cost price, and for interest, difference between 1 and 2 into the interest rate, maximum for a 3-day period, in this case from 10 to 13 June. So if I look at swap cost over here, which they are asking you, which is the difference between 2 and 3. So you will take spot sale. Spot sale kitna tha hamara? This was 127.6. Additional action that the banker had to take because you did not come. Spot sale, this is like the selling price. And then there was a forward buy. Again, additional action which the banker had to take because you did not come. 127.9. 127.9. This is like your cost price. All of these steps are given, let us say. So over here, selling price minus cost price, 127.9 minus 127.6, and hence there is a 0.3. That is 30,000 loss, and you have to recover this loss from the customer. So swap loss is 30,000 to be recovered from the customer, and interest on outlay of funds, the difference between 1 and 2, that is 128.56. that's a cash outflow. 127.6, it is a cash inflow. So if I look at interest, 128.56, this is my cash outflow, minus 127.6, this is my cash inflow. So this is a net cash outflow of 128.56 minus 127.6. This is 0.96. If I take this in full numbers, probably 0.96 thousand into, what is the rate? There is a rate given to me at 12% into 12%, but this is only for a 3-day time period out of 365. So if all of this is done in lakhs, 96,000 into 12% into 3 by 365 comes to around 95 rupees. Again, this is to be recovered from the customer. Remember, if any of them is payable to the customer, we will not pay in the late cancellation case. The new contract and the total cost. See, the total cost will be 156,740 plus 30,000 plus 95. Whatever that number comes is my total cost. Now, the new contracted rate is between you and the customer. Customer comes late. Better late than never, but wants a contract to mature on 10th of August. So over here they want a forward buy because they are an importer. But when did the customer come, sir? The customer came on 13th June. So if I want the new contract rate, I will look at the rate on 13th June for a 2-month forward, or rather August forward. Acha, for August forward, the customer wants to forward buy because there is an importer, and hence if the customer wants to buy, the banker would want to sell, and hence the August forward ask rate, that is 64.25. I would take rupees 64.25 per dollar. On 13th August, the customer came up. So on that date, you will take the August rate of 64.25. Sir, why 64.25? Well, you want to buy, the banker will want to sell the dollars, and then 64.25. However, will the exchange margin apply over here? Yes. Like in the question 9, exchange margin at the rate of 0.1% will apply. Thankfully, there's no separate buying and selling. If there was, you would have done similar to question number 9. So this is 0.0643, let us say rupees 0.0643 to the dollar. The problem is, will you add or subtract? Well, for the customer, this is a cost, and hence this will increase. So you will add. So over here, this is plus 64.25 comes to probably rupees 64.3143 to the dollar. This will be your new contract rate. So if I go to see, first my cancellation rate is 63.6163, 1,56,000, swap loss is 30,000, interest is 95, ultimate total of the 3 and 64.3143, and that will take care of question number 11, all the sums over here. Now if you refer the theory, maybe you might get a slightly more better understanding. So cancellation charges as per rule 6 of FedI, loss on cancellation to be done from customer's perspective. It is only unique to late cancellation, not to early delivery, because there is a cancellation here. How do you find the exchange difference? Like cancellation on the actual date of cancellation, that is your agreed forward rate, in our example 64.4, and the offsetting spot rate adjusted for exchange margin on the date of actual cancellation, sir, that is 13 June, which in our case came to I think 63.6163. So that is only and only in case of late cancellation. When it comes to other costs, swap loss, we will say that because we have to honor the offsetting contract, we will probably have to kind of receive the dollars. So we will have to enter into a spot sale. So if there was a spot sale, this is the additional action that the bank has to take because the customer did not show up at the original maturity, that is a spot sale on the date of original maturity, that is 10th of June, and the offsetting forward rate that you enter. So if there was a spot sale, then there would be a forward buy. If there was a spot buy, there would be a forward sale. And then interest, this is on actual cash outflow. Actual cash outflow also arises on basically step 1. This is your dollar value into the cover rate 0.2. This is a dollar value into your spot rate 0.3. This is a dollar value into the opposite. So this is, if this is spot buy, this is forward sale. If this is spot sale, this is forward buy. Remember, from an exam perspective, if you want to find a swap cost, whether it is early delivery or late cancellation, it is the difference between 2 and 3. Selling price and cost price ka difference nikalna. And when you look at the interest cost, it is the difference between 1 and 2. That is cash outflow minus cash inflow. If it is a net cash outflow, into the interest rate into the number of days, that is 3 by 365 as the case may be. So this is kind of running through this, but honestly this itself warrants a separate discussion on its own, and in your main class you would have spent a lot of time behind this. If you understood this, well and good, but don't leave this, at least have this broad stepwise understanding just in case it comes and comes in compulsory. Remember the steps and do it. Don't have the habit of leaving something, yaar kar do, aa gaya, nahi samajh mein aa raha hai. Even if when we were students, we would not understand 100% of the Forex chapter. Even if 80-90% of the chapter is broadly understood, 10-20% like this late cancellation or a few things here or there, just try to remember, acha, if this comes, we have to do this. Chalo, Bhagwan ka naam lene ka, pray karne ka, and then you proceed. Leaving this does dhak 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 in your heart. So avoid doing that. And I think we have tried to cover as much as Forex to the best extent possible. I think it took around 4 hours or so. Chalo, I really hope that this session has been helpful to you. If yes, please do like the video and subscribe to the channel. If you have not done this, share it with your friends, and in the chat box, in the comment box, please do let me know in case you want me to cover any specific topics, any specific areas or something, and I'll be happy to probably try to cover them to the best extent possible. So till we meet next time, good luck, goodbye, and take care. Keep studying hard and keep rocking.